We'll do it live.
Okay. No.
We'll do it live. F it. Do it live. I'll write it and we'll do it live. F***ing thing sucks.
Yeah.
Oh, okay, here we go. Audio is too loud. All right, so we're here. So I'll actually change the timestamps real quick. Let me change the timestamps and then we'll get started. So we'll start at exactly 6 minutes. That's when I got on here. I thought I had my thing on the proper timer. Okay, let's get right into it. So let's first talk about the CME group. Noise is making my nuance, my deer and headlights. Is there a noise you guys are hearing? Let me know if there's a noise you guys can hear. Hold on. I think I'm getting a call from someone. Hello? Oh, one of you from the audience gave me a call. I think I was having something, and some audio error. Ringing is deafening for real. Wait, is there a ringing for you guys? If there's a ringing for you guys, let me know, and then I can try to see if I can fix it. Yes, voices. All right, I'll continue as if there is, because I don't. Okay, it's all good now. All right, thank you, Jason. All right, so let's get started. So we're officially starting right now. Let's get right into it. So this tool, which is a good shout out, the CME Group FedWatch tool, it gives you a general idea of what the federal funds futures are telling us about what the predictions of rate cuts are going to be. Earlier today, this was 55% for 50 basis points or more, and 50 basis points, let's say. And that's exactly what we got. I forget the exact source as to what we were, where it came from, but the analyst community was actually saying 25 basis points, but we got 50. So another win for the FedWatch tool, I guess. But yeah, generally speaking, the bond market tends to be one of the more efficient, especially in the treasuries market, tends to be one of the more efficient markets out there, and tends to be more correct more often than not, but it's not 100% of the time. Okay, so let's talk about what happened today as far as the reaction, and we'll go over, does it even matter to you? Should you even care? Does it change your future, etc.? So initially, the index had initial drop. You can see that right there at 2 o'clock, but it was very rapid and faded away into a rally and euphoria, and we're so back. And then as we faded that rally, throughout the day, we had some of the FinTubers come out and say, buy my course. This is the beginning of the sell-off, yada, yada, yada. And that person is none other than me, Kevin, very large YouTuber, financial advisor. And every single time this year that he's been bearish on the market was a good time to add, because he's a very good contra, because he actually doesn't know what he's talking about whatsoever half the time. And I did a private live stream with my club members back in April. And then I also did a public live stream back in April, just a little bit after, with the same call to action. So there wasn't there was both a private and a public call to action. It was the same. It was, this guy tends to be the guy you want to use as one of your contras. And as a macro contra, he's definitely fits the bill. So if he's saying that, this is the sell-off, here we go, be bearish, etc., maybe it's probably going to be a good time for you guys to start adding, and just ignore the noise. So let's cut to the chase. What does this mean for you guys? Does the federal rate change your investment futures? The answer is no. I don't really think paying attention to this really does anyone any justice. And I think that with what we can expect for stock returns, who knows? Really, who knows? Perhaps there are going to be certain consequences that come about of this. We're going to talk about some of them, because I was reached out with some questions that I wanted to answer here in this live stream instead of for me typing it out. You guys know who you are. And one of them, we'll get right into it, is the Moody's, let's call statement regarding bank credit, and why they think this is going to be negative for the creditworthiness of some banks. So Moody's came out with this statement, and that initially concerns people. They're like, well, what does this mean? So the textbook understanding of what the effects are on the sudden drop in rates is the following. So banks have balance sheets of varying credit ratings and different maturities. And let's say if I'm a bank, in this metaphor, I'll try to simplify it. I'm issuing a bunch of loans right now at, I don't know, make it up 7%. Then rates decline whatever to, I don't know, let's say 3%. And we're kind of going to ignore the differences between the short end of the curve, the long end of the curve. And, it's a whole complex topic. But sticking it to simple, when rates go down, then that increases the risk that the people I'm lending to may refinance, because at the end of the day, money's a commodity and they can go to any bank that they so wish. So then this can put pressure on my portfolio, and I'm issuing new loans presumably throughout that period, and all these new loans that I'm issuing are going to be at progressively lower rates unless I'm going up the risk curve. But let's say I don't want to go up the risk curve and I just stick to where I was currently at in the risk curve, and my rates in theory should be going down as far as how much money I'm lending. We can go into a discussion about real versus nominal, but we'll stay out of that for now. So just thinking about nominal, as rates go down, this does imply that my portfolio does present an interesting amount of increasing risk. So what we saw when rates were really low is a bunch of lending happening at really low rates because there was a lot of demand to borrow. And of course, this spurred inflation. We'll step away from that for a second because a lot of people, think Federal Reserve print money, but whatever. We won't get into that. And that spur of lending demand spurred a lot of, lending growth, and a lot of banks grew their portfolios quite massively. One of the money center banks that you can think of that really exposed themselves to duration was Bank of America. So Bank of America had a lot of duration exposure. JP Morgan had really minimal duration exposure. I think the lowest among US bank as well. So it's them two that are of the larger banks that had very minimal duration exposure. And so when you have the rates coming down, something like a Bank of America, they might have some a breadth of liquidity again, because they could sell their loans and not necessarily for a loss. Well, still, if they were to sell it now, they're still underwater. But they're if it goes down enough, they could start selling it at maybe not a loss. The credit risk is a different story, but presumably, if you have all this refinancing and you're still issuing new loans, your portfolio as it turns over is going to have an implied higher risk because the interest rate is supposed to compensate you for the risk. So that's the textbook understanding of why lower rates can have a negative impact initially. And then as kind of banks start to shuffle through, maybe they increase their lending standards, they make it harder to borrow money from them. Things can kind of, settle down a little bit, and things will settle where they may. But in the time being, that I think that's what Moody's is trying to say. What exactly are they trying to say with that? I can't really tell, but that's my initial impression. So interest rates coming down can have that negative impact on banks in the shorter term. Again, not all banks you're going to have to worry about to the same extent, but this is just broadly speaking across the board. So loans that you as a bank, let's say you were the bank again, you really were hoping you could hold that for, I don't know, however long you lent it out for. And let's say you thought you could hold it for 75% of that time before they refinance, or maybe 100%. Maybe now that's shortened quite a bit. And some other bank is going to offer them credit and they're going to refinance. Or they come to you again and they say, I would like to refinance. And you'll say yes, but now you'll get the same at a lower rate. So implicitly that's worse off for you. So, okay. Let's see. Chat has like a whole life of its own. Trying to see if there's any questions. Rate cuts. Yes, Cole, rate cuts. So in summary of the topic, I think if you're paying attention too deeply and too intensely, you're gonna miss the boat here, and you're more likely to make a mistake than not make a mistake. So do with that what you will. And then let's kind of get into the we'll skip this a little bit early. What time is it? 15:40. So I'm going to change one of the timestamps and we'll get into consumer health because I want to actually spend more time on this. So we'll say 16. All right. And again, you guys can, if you refresh your screen, you can see the updated timestamps. But anyone watching and you didn't know, there's timestamps that kind of keeps us on a schedule. All right. So consumer health. In the thumbnail, you might see a couple stocks. I didn't mention Booking, or I didn't put Booking's logo, but we'll talk about Booking. So real quick, let's talk about Airbnb and Booking and the travel sector. So ABNB had a pretty strong rally in the last couple days, and we'll illustrate that here. And it was yesterday that they had a really strong rally, along with Booking and Expedia and all that. And so this comes off the back that there is renewed optimism about travel, the consumer, et cetera. And you got to consider, okay, well, what customer is the consumer in the travel sector? It's the higher middle end consumer who has discretionary spend capability or discretionary spend capacity. And we can tie that in with Disney, although I'm going to talk about Disney later on in this live stream. I'm going to have a dedicated segment to Disney, but you could lump that into this discussion we're having here. So Airbnb and Booking, they also benefit from an additional point of their business model where they generate income from the money that is flowing through their system. So if I pay for a Booking reservation or a Airbnb reservation, and my reservation is not until a month from now, but I paid in advance. Airbnb will have that money, and let's say in transit to the owner of the property. And while they're holding that money, what do you think is happening? Well, they're putting it into some short duration cash or interest generating instruments, And where were interest rates recently? Well, if you guys didn't live under a rock, you know that you could get pretty much about 5.3% by just closing your eyes. If you're just a tiny bit scrappy, you could get a little bit more. And then really you could get also CDs. But the point is they could throw it into treasuries and generate a meaningful return right there. And so what does this mean when rates come down, which is kind of also perplexing to me. And I think I would be a fair bit cautious, but not bearish necessarily on Airbnb. Because when I look at some of the ways they make money, well, I don't think consumers out of the woodworks just yet. And this rally seems to imply that those fears are gone. And also interest rates again coming down it does reduce the earnability for one big part of their business, which again is that interest income that they generate. And then the same thing goes with booking. I think both businesses are phenomenal. Airbnb does have some regulatory hurdles to go over. Booking, though, to be fair, I think has a wider moat around it, and what they're doing on their platform that's competing with Airbnb, I think is remarkable. And I think they're mostly taking share from Expedia, if I'm being honest. But Airbnb in isolation and of itself is doing fairly well. If you guys haven't listened to the Acquired podcast, I recommend it for Airbnb. Just talking about how the company basically or the founder found out they didn't really have to spend much money on marketing. They were already a verb that was used to describe the act of getting a short-term rental. So really interesting. Oh, no, absolutely no such thing as stupid questions. We'll get right into it. So Capital Minds, sorry if this is a stupid question, but I think it makes sense. I recently learned that callable CDs, sorry. You think about banks having to worry about refinancing. It's almost the opposite. It's like customers can call their mortgages. You're saying a callable CD for the bank. Yeah, like you can request to redeem it. Yes. Oh, Gail, it's because I didn't see your questions. Sorry. But yes, Cole, in a sense. I'll scroll up for your question. This is very elementary opinion, but in general, that's a simple way of putting it. That's, I think, the very surface level conclusion someone can make is that yes, dividend stocks will do well if interest rates go down, because what he's describing there is like people hunt for yield, and some people, they look at bonds, right? You're saying I want to generate 5% a year in income, and rates go down, and now you're like, I still kind of want to generate 5% per year, and I want something fairly predictable and safe. So you start to see maybe that capital will go and fly into some dividend paying stocks that are more on the blue chip side, and they're going to be like bond proxies. So if you think about it, there's some stocks like off the top of my head, Procter & Gamble, Mondelez, where I don't think they'll actually outperform the market, but they'll give you bond-like returns, a little bit better than bonds returns, but they have a fairly low but growing dividend yield, and they're not as volatile. I said two tickers, but you can kind of pick and choose. You'll find a bunch of them out there. Think of consumer staples trading at pretty high multiples. Think of earning yields in the maybe 4 to 5%. And, again, growing dividends is usually one of the characteristics of them. But by extension, you could argue, some of these higher dividend paying stocks will also have that same benefit. Preferreds, which they're also, in theory, should also be appreciating in this environment. The other thing that has been, and we said, this is finally happening. So I haven't gone live to talk about this yet, but I hope you guys have been noticing, the year of accumulation of REITs and what's been doing really well past couple months. REITs. So we have a few that we can mention, some honorable mentions. We won't stay too much in this topic, but some of the stocks that we've talked about in this channel: KRC, Sun Communities. Alexandria actually hasn't done that well. Agree Realty, the superior realty income, but just REITs in general as an asset class, they've done fairly well. And it makes a lot of sense because if you have rates coming down, it does imply that the cap rates of the properties could also go down, the NAVs go up. You also have this mechanism that Gil is asking about, which again, that's not a novel idea. It's rates go down, some dividend paying stocks can experience some appreciation, but in general, Gil, to kind of elaborate on the topic, in general, if rates come down, all assets should go up because it's all a beauty contest on return. So if you're looking for some target return and you're like, let's say your hurdle rate's 5%, like you have to earn 5%. Well, now you can't invest in certain assets. It's not viable. It doesn't match your hurdle rate. So you're going to have to find something else to buy to get that 5%. Now, the risk profile may be different. That's a different discussion. And then there's going to be different products available to those investors. Comes in private equity who will offer or advertise that, return with less volatility, but, it's a different story. But in general, all assets should, in theory, go up in a declining rate environment. So REITs gave me life again. Yes. Do you think REITs have been priced for a rate drop? Well, of course, a portion of the rally in REITs, some of the REITs, was due to the expectation that rates would fall. And I think that you didn't have to wait for the Fed. So I don't think you should actually be using the Fed as an indicator, because remember, the Fed only controls the short end of the curve. This is kind of why I was leading with the topic of the Fed cut rates. Does it matter? Does it not matter? I'm of the opinion it doesn't. I'm of the opinion it has an effect on some aspects of the market. But for example, with REITs, what you actually should have been paying attention to is the medium to longer end of the curve. And as you saw those rates come down, then you saw the REITs actually start to rally and pick up. Because again, that's where they're typically dealing with when you're looking at real estate, for private equity, like a standard, duration of a fund is like, 10 years. The standard holding period of real estate, like super standard textbook, is considered like 8 to 10 years. And so if you're using the interest rates and you're looking at interest rates for 8 to 10 years, that's like your what you can use as like your hurdle rate, what's your risk-free rate. So that comes down, and you again, that's going to be what's affecting the end NAV of the real estate. And right now, I've made live streams about this, but let me remind everyone, in 2023, some real estate asset types or property types were at their lowest discount to NAV that they've been since 2008. And so the question I asked to the audience is, where were you? Were you buying REITs at their lowest discount to NAV since 2008? Most likely, many of you, probably not. And if I'm being honest, it's more evidence to show you that when things actually get hairy, most people hate on it. And it's perfectly fine. It's perfectly normal. And maybe, personally, you don't like REITs, and that's fine. There's nothing wrong with that. There's other asset classes that will do fine, if not better. And if you're better equipped to understand those, more power to you. Just stick to basically what you own or what you know. But anyways, coming back to just the topic of REITs, I can't tell you that there was a lot of negativity. I'll tell you, if you guys are not in the club, within the club, there was a lot of negativity last year, even a little bit this year. Not a lot. Let me reframe, but there was some negativity. And then on the public streams, yeah, there was some negativity. And I saw other YouTubers come out and say, I'm not going to call out a name specifically, but they would never invest in REITs. REITs are a broken business model. And I was like, that makes sense. You're saying that in the midst of like one of the largest REIT downturns in the last 20 years. Again, some of them are at the level discount as they were in 2008, or were, not anymore. They've since all rallied from that. But it presented some interesting opportunities out there. And for me, I have a I have basically a handicap as to how much REIT exposure I can have, because REITs are inherently, well, they're tax efficient technically, but they're best to be used in a tax advantaged account, which is where I focus most of the allocation to, which inherently limits the total contributions I can have. But when I have it in a tax advantage account, the benefit, I'm not your tax advisor, so consult your own tax advisor, but the inherent benefit is they don't get taxed at the corporate level, and then you don't get taxed at the individual level. So the full profit is not taxed. And then just a quick tangent on this. You might hear some REIT analysts pitch REITs to you as this magical asset class, and they compare, REITs to traditional equities, and they show you that historically they've outperformed. There's like a big caveat to that I want to address. And I know it's because they're trying to sell like a research platform to you on REITs, specifically on REITs, because they specialize in REITs. REITs are great, but the comparison is a bit misleading, because what it doesn't take into account is taxation. Because when you're looking at a stock index, there is an implicit tax consequence in the price of the stock, because corporate earnings are reduced by the tax rate, right? You're with me there? But with REITs, they're not paying tax on the corporate level. So there's an inherent advantage to the corporate earnings of each asset class. So one is not getting taxed and the other one is getting taxed. But then you have to go in there and then account or adjust for the individual taxes. And then it might actually still end up being that C Corps may be a little bit better over the long term, which kind of makes sense, because REITs, real estate doesn't scale as much as some of these C Corps can. So I would tend to think that that's the case. But a lot of people start pitching, REITs as like this magical asset class. It is true that if you don't account for taxes, they look really good. So that's something you got to think about. So if you hold it in a tax advantage account, more power to you. Okay, so let's see. Did you see futures right now? You know what? We'll go on everyone's, just to trigger some people. We're going to go on the futures market, but on everyone's favorite news site. Does anyone know where I'm going? Everyone loves them. They're the most trusted name in news. All right. I'm getting targeted. Here, let me see where I'm at. All right, there we go. I love how some of you guessed Yahoo Finance. One of you guessed me. Oh, I love it. Investing with Cole said Reddit. All right. Anyways, so futures are green. Oh my gosh. Tomorrow's going to be so green, guys. See, this is why you sell everything like a clown and you panic. The point is, and I'm going to emphasize this point one more time. So now that we have the futures in front of us, gambling on the macro is probably not, and the keyword on gambling, because you can redirect strategy based off of macro, and that's fine. So like you can do a bottom up analysis where you say, okay, I'm looking at this company. I like this company a lot. Everything checks out. And then after all that, then you start to think about, okay, how does these following scenarios work out? Is it better? Is it worse, etc.? And then you can make a decision, and that can affect on how much you allocate to it, because the allocation should be a reflection of your confidence, how worried you are, how much you can stomach as far as a drawdown. But it saying I'm going to sell all my stocks and then go on vacation and then come back at a certain random date. I know why he picked that date, by the way. He's picking that date because the September slump. Oh, we didn't have a live stream, so I can talk. I have to talk about this because I talked about this with the club members last week, and I stated the following. Everywhere on the internet, I was seeing, oh, the September slump, this and that, and this and that, only after the first week. And then everyone started talking about it. So that tells me, and these same people weren't talking about it the year before, right? So that tells me we weren't going to have the September slump. So then I said in the private or weekly call, we should probably buy this dip. And then it turned out, if you did pretty well, because it tends to be like when the crowd starts to like shift and think something's going to happen, it's probably not going to happen at that point. And you guys might, sympathize with that, because I know a lot of you guys enjoy contras or contra signals. But coming back to the topic at hand, we have futures are green, and we opened up with the discussion about Meet Kevin's recommendation. All right. Need I say more? I mean, every single time he's done it, I jokingly say like 13, 14. I change the number every time, because I honestly don't know how many times he said this year that we should sell everything and, I don't know, go into whatever. But if this time is yet again another time, it will be hilarious. I think it would be just like a running joke that we can keep on going, or see how long it goes. So this is really fun. Yeah, Greystone flip-floppers. No, I'm serious. It's really funny. The September quadruple witching. Yeah, no, but I that was seriously the thought that came across, is like, everyone is saying the September slump. That means it's not going to happen. October slump, maybe the September slump doesn't happen, and then everyone goes, oh, now we're not going to have a slump, and then there's a slump. But let me get back to the topic of why Meet Kevin chose November. He's doing that because he's trying to follow like a pattern of this has been the case, but nuance isn't applied, and so you just have looking at charts and saying this happened then, therefore it's going to happen again because reasons. And if you look at, for example, in some prior elections, but more recently, there's a recency bias. If you look at 2020, actually, let me just pull up 2020. So let's go back to VU. Let's go back to the 5-year. And then you can see right there, this dip right here. This is the beginning of November. And then we had like a massive rally after the election. Because the idea behind that is the market doesn't like uncertainty. And so you had what is this? I know it looks really small nowadays, but just like, trust me, bro, back in the day, this was like months of going nowhere in the market. So you see it was down 3.13%, but it's after, a fairly decent rally. If you consider the full year, though, let me show you. It was a pretty flat year up until that point. Right. Oh, I'm trying to get there. 1.21%, whatever. So at that point, the election results came out not too long after, and the market, the textbook explanation is the market doesn't like uncertainty. And so once the uncertainty is gone, you tend to see a return to, let's say, bullish sentiment, a rally. So, oh, I wasn't even sharing the tab. I apologize, but I was talking about this slump over here. I have to remember to change tabs and all that. Doesn't read the chat. No, I try, but sometimes I go on a tangent and it's off to the races. You're not sharing a chart? No, I'm sorry, guys. You should definitely sell everything and become a doomsday prepper. Repost. Come on, so can you explain the size of effect that the Fed funds rate has on mortgage rates? My friend is excited so they can buy a house, but I know the Fed doesn't control long term. Yeah, so no, mortgage rates have already been moving. You should tell your friend to look at the historical rates and mortgages. Mortgage rates have already been moving. They move almost like independently or ahead of the Fed. So again, the Fed controls the short end. You could see it continue to go down because that's the current trend. But who really knows? I don't know when it's going to bottom out. There's a lot of discussion that the housing volume will still be will be lagging the change in rates, because a lot of consumers will think exactly what your friend is thinking, funnily enough, right? That's the discussion I've been hearing. So people have been saying, well, consumers are anticipating rates are going to be lower. And there's in economics, there's actually a word for this to describe this. Chat, help me out if you remember it, just type it in chat. But it's, when prices come down, you could get into this like deflationary spiral. This is for describing normal goods and services, but the same thing can be applied to mortgage rates, because mortgages are a product. And so if you think the cost of the product is going to go down in the future broadly as a consumer, then the consumer may hold off on purchase of said product in anticipation that the product price could go down. And this could cause you know, like a deflationary spiral. So if you think about it like this, you know, there's, I don't know, I'm going to make up a product, eggs. So eggs are going down in price. And then everyone, we all think together as a, you know, a national community, oh, the price of eggs is going to go down, but it's going to go down a lot more in the future. So I'm going to hold off on buying eggs because I'm going to wait for it to go down. And so that puts pressure on the sellers of eggs. You know, they don't want their produce to spoil, so then they lower prices, fulfilling the prophecy that we ourselves told. And then so we may continue to think the same thing, and so we get to like a exacerbated drop in egg prices. I just came up with a random example. The egg market is not that simple, but that illustrates the example of what you might learn in an economics class. You know, super basic. So I think it is deflationary spiral, like I said, and then so okay, that is the word. But that is the that is part of the discussions I've been hearing as far as like why we're not going to see a immediate reaction to housing volume, is that a lot of people think exactly that. They're like, oh, I want to buy a house, rates have come down, but I think they're going to go down more, so I'm going to wait. So deflationary bust, reflexivity. It might be reflexivity. I don't know. But I think it is deflationary spiral. I think the term is used as typically deflationary spiral, but it's not for this because this is talking about, you know, rates, not necessarily deflationary per se. But there we discussed in the past, you know, talking about liquidity crunches, et cetera, and the like. When you have like banks want to lend, and then you have consumers that have to be willing to borrow. So you need both parts of the equation to work together. Banks willing and consumers willing. They both have to be willing. One has to be willing to borrow and the other has to be willing to lend. So that's kind of like the happy medium that has to be, you know, the equilibrium that has to be met at some point. So we might see that, you know, in 5 months, 6. I have no idea. You have to think about the yield curve, and banks don't want to lend right now. Exactly. No. Right now, it's most banks are cautious. Most banks have been cautious for like the past decade or so, frankly. That's why a lot of private credit has stepped in and assumed a lot of the roles that traditionally has been filled by banks. So you have private credit, you know, managed by private equity firms. And this is, well, synonymous with direct lending, et cetera. But this has been the products and the entities that have fulfilled what the banks used to fulfill. Ever since 2008, most banks, broadly speaking, have taken a step back in some of these lending avenues. Yes, Dex, very funny. When you get margin loan to buy a house, is this a good idea? Hell to the no. Out for fun. So we're approaching, I think yep. Actually, we missed our brain rot discussion. So I have something entertaining for you guys. Hold on. Let me go ahead and correct timestamps. And so I'm going to give myself 5 minutes for the brain rot. So 48. All right, just adjusting the timestamps real quick. All right, so intermission time. We shall, you fail to suspend the belief. Stop capping on private equity. We have all these questions. Sorry for the spam. Thinking about JD Vance's plan to depreciate the US dollar against other currencies to boost exports. Bullish for stocks. I don't know how he plans to go about that because he's making it sound easier than it is. You know, the euro dollar system is much larger than the US would like to admit sometimes. Okay, so little broomstick. This is the actual intent of this, because a lot of people some people actually do say that unironically, and I genuinely, the only thing I can tell them is like, well, this is not meant for you. I don't jingle the keys, in front of the camera. Frankly, the capital mindset community, from all of the people I got to know over time, a bit more. They can joke around when they want to, but they can be serious when they want to, and. We're not. I know I'm not an ADHD friendly, YouTuber, but I never will be. I don't plan on doing that. I can't stoop so low as to do that. So I know you might be saying it ironically, but no, I believe it or not, I do get that sometimes, and I'm like, okay, not meant for you, buddy. All right. He meant he misses me. Yeah, no, that's true. China's very bad shape after this past weekend. People lose their homes. All right, we're going to get into this brain rot real quick. I found this clip fairly entertaining. Okay, ready?
Question I have is, so if you were to start all over from the beginning, would you spread, say you had 20,000, would you spread it through weekly, or would you just focus on Misty and just get it every month?
I would just focus on single stocks, one fund, because you get the maximum, the highest one. Back then, the highest one was Tesla. The highest one right now is Misty. So I would just focus on Misty, just like what I'm doing for my wife account. My wife account only have Misty, and so why? Because you're getting the maximum return at the maximum input, and when you get all that profit back, you're going to put it back in. You're just going to grow really, really fast,
I just want to share that with you guys. Because that's probably one of the dumbest things I've heard in a very long time. That's because again, this gentleman is probably, unfortunately, I feel bad for him because he probably was born with it. So like there is like a limit to his capacity, I guess, in that sense. So it's like I sometimes struggle with, do I talk about, but then I see like he has some malicious tendencies, and he is dishonest with a lot of things. So he deserves a lot of the things that are happening to him. But in general, like that questioning of like, oh, should I not, aside, this is probably one of the dumbest things I heard in a very long time. So a gentleman who sounds, young, inexperienced, has presuming by the question has $20,000 to invest, is asking him like, hey, do I spread it into these stupid funds, or do I spread it into, or put it into one stupid fund? And then he's like, no, you don't spread it into multiple stupid funds. You just put it into one stupid fund. And the stupid fund that he chooses is Misty. By the way, I'm calling it stupid fund on purpose. So let's talk about Misty for a second. So if you guys have never heard of Misty, and let me also state the following. I talked about in the previous brain rot intermission, I think in the last live stream, that this individual borrowed money at 22% interest rate to invest in Misty because he has the belief that he's going to be making all this money, but he's not. So the amount of exposure this individual has now to Bitcoin, or to crypto, is, well, Bitcoin specifically, is incredible. So you have this fund that, yeah, capital appreciation is, you're getting wrecked. Not as wrecked as other ones, but you are going to get wrecked, especially. So if you look at it versus MSTR, and I'm not going to pull up a total return on this one, but you'll get the picture. Here, I'll put up year to date at least. So a lot of it, you're getting it in the most tax inefficient way, et cetera, yada, yada, nothing we've already talked about. And you're guaranteed out underperformance over a long period of time, unless there is a specific level of realized volatility. All that being said, putting it all into one fund and not understanding that it's like picking an individual stock and going all in, which I would think is degenerate enough, except for one of you out there that, you know who you are, and I'm cheering for you, and you're a one stock only guy. You're in the club and you're a one stock only guy. good for you. And it's working for you so far. But generally speaking, it's considered highly degenerate to say, okay, I have all these opportunities in front of me. I'm going to go all in one stock. That's it. That's the same thing of just going and buying one stock. If you have $20,000, do not do this. Poor guy, because he's going to learn an expensive lesson. And, there's nothing any of us can do about it. That guy's going to do what that clown tells him to do. And he's going to learn a lesson. But it's a lesson that he needs to learn. And then hopefully he learns it, actually, because some people, they get hit hard and then they go, no, I just didn't go hard enough. If only I did this or that, it would have worked. But hey, it's their money. Who cares? But yeah, some of you are noticing that, by the way, like what I said, I question, is it fine to make fun of him because he was born with this? Like, what I mean is he's born with like low IQ. So like he's not able to understand the situation he's in. So he thinks he's going to be rich. He's never going to be rich. He's just going to lose a lot of money and not reach his retirement goals ever. So he's dooming himself. In fact, I want to say the longer he does this, the worse it's going to be, because the tax bill is also going to be pretty insane. And so he's going to owe a bunch in taxes, etc. He won't learn lessons. Kemmer avoids taxes. Oh, you're referring to, I've heard from some of you. I haven't seen the clip myself, so I don't want to say it definitively, but I have heard from some people that he may have some back taxes that he has to pay. I don't know. So, unless it was meta, then you're cursing. All right, I think we're done with the brain rot intermission. So coming back to the topics at hand. So let's get back to it. And now we're going to talk about legacy media, Disney and Warner Brothers. So stock number one, Disney. What can we say about Disney? Quick rant. Reminder, how I feel about Disney. Wonderful assets, terrible management. And it was a great move that as soon as the proxy fight was over and they lost, that it was a good time to exit, because the sentiment catalyst had played its part, and you buy the rumor and then you sell the news in that case. So that was a good move. What are we looking at going forward? Well, real estate has been and will continue to be a good value component for Disney. What I mean by that is there's a lot of land on Disney's balance sheet that isn't valued properly, or it's valued properly. It's valued in accordance with GAAP, but it's not valued to what we would care about as an owner, as an investor. The real estate value is very difficult to determine, but it's definitely way higher than what they have listed. And you know what? I'll go ahead and let me pull up the 10Q so I can show you what it's currently listed as the book value. Give me 1 second as I pull this up. All right. So we get this guy going. Revenues, assets. There it is. All right. I'll zoom in a second. I'm going to pull you guys back here. Okay. So this is what I wanted to illustrate. The land value. This is definitely not true. Now, recall that land is never depreciated. So you do not depreciate land. You just hold it at what you have as book value, but you never depreciate land. So with that being said, that land is not worth, the fair market value is not reflected in the balance sheet right now. Now, that doesn't make up for everything. I just want to make that also known. It doesn't make up for anything. So what you have here is great business segments in the parks segment, with a lot of CapEx reinvestment that I was hoping for is happening at Disney. And that's going to expand the earnings potential for the next decade at Disney. So some of the things that are going on, for example, they're building Zootopia and Animal Kingdom, Indiana Jones section. They're also doing Monsters, Inc. So that's going to bring a lot of families, because, you know, you have a kid, your kid watches that movie, that Pixar movie, and they're like, oh my God, I want to go to the parks and see the characters and ride the rides. So you're going to have that. The other side of the business, the media side of the business, they have abysmal projects like Acolyte, where you spend 160 or some odd $1 million and you get that utter trash. While Warner Brothers, by contrast, spends less than that. I come to find less than that, and they're able to come up with House of the Dragon. Now, I don't know if you guys have seen House of the Dragon and Acolyte side by side, but to be fair, I could not watch Acolyte. I could not watch it. It's that bad. But House of the Dragon, fantastic show. I think that's the general consensus. Acolyte, consensus is absolute trash show. Everyone wishes it was never made. What happened? Well, I'm not going to get into the whole culture war thing, but it's hard to avoid it when talking about Disney. Disney has forgotten what's meant to be a creative. And the business model for how Netflix does it is so different and beautiful when compared to Disney, because Disney does not do a lot of the outsourcing of projects. So a lot of times with Netflix, for example, you get a pitch. You pitch Netflix. Let's say, I don't know, I'm going to pick someone at random. Fuhat and I, we come up with an idea with a show. Here you are, Fuhat. We can't see. What do you mean you can't see it? You can't see this? I think you can see this. All right, but Fuhat and I come up with an idea for a show, and our show is going to be about, because Fuhat loves PE. It's going to be about a private equity fund manager and the struggles that he goes through on a daily basis, right? And it's going to be a comedy play, not a play, but like a playful spin on the whole thing. And we're going to pitch this to Netflix. Netflix is like, all right, we like it. Here's some money. Go make it. Disney's like everything's born from within it. So you have to deal with the cancerous culture that is at Disney as far as the creative side goes. So that's something that you have to contend with. And I don't know what the answer is to overcome it. Maybe there isn't. So that's why Netflix has surpassed the likes of Disney. Warner Brothers has actually tended to maintain a good, solid creative culture. But however, they have a different business model from Netflix in the sense of how they create stuff. So Netflix likes to create a bunch of things and then, creative destruction. From that, many things that are created, a couple, or, maybe let's say they make up a number, they create 100 shows or 100 shows and movies. 10, 15, 20 of them are hits and the rest are trash. I'm probably exaggerating the numbers there, by the way. And then you have Warner Brothers. Warner Brothers is like, we have this many shows. It's barely shows. We're just going to pump out these shows. So some shows that are, House of the Dragon, but that takes a lot of effort. They're going to come out with the Harry Potter show. They're going to probably put a lot of emphasis and effort on that one. Succession, another highly, not sought after, but highly effortized form of media. So movies, Dune 2, these are epics, right? Netflix is like, here's this. And then people are like, wow, this is good. And then this blows up. So Netflix is following what I think is one strategy that will be successful. And Warner Bros. Is dominating a different strategy that I think they can be successful. So I hope I'm illustrating that point to you guys and why, I've really liked Netflix as an investment, and I don't think I'm going to be selling anytime soon. As a media culture, they're phenomenal because they understand that this form of art requires creative destruction. And I think a lot of people didn't understand that, because when I originally invested in Netflix, a lot of people said they have some good shows and a lot of bad shows, and they kind of miss the forest for the trees. Like that's kind of like the point. It's like you try a bunch of things, you try everything, and then some things are good, some things are bad, and the things that are really good, you keep investing in it. Just kind of like how you do an investment portfolio. Let's say you invest in a bunch of things and then you sell the weeds and you water the flowers. That old saying? Netflix does that with TV shows. On occasion, they cancel something that some of you might like, but the numbers don't give. And so that's why they cancel it. If it's not very popular, just don't give it. And if you see Netflix is consistently in the top 10, consistently dominating the charts every single time, no one comes close to ever getting the same amount in the top 10. So it just is what it is. Hey, you can hate all you want on it, but with Disney, consistently they're not in the top 10. Consistently they're spending too much money on projects. Warner Brothers makes it. Disney very so often will stay there for a little bit, but Warner Brothers has had shows that consistently stay in the top 10 for several months. House of the Dragon is one of them that comes to mind. And probably we'll see with the Harry Potter one that will be good. And then again with movies also, Disney has better success in movies than TV shows. TV shows, I think, Jesus, like Shogun was it, and really that's about it. But anyways, and also this is true. Thank you for mentioning this, because I was going to mention this as not semiconductor engineers, software engineers at Netflix are one of the highest paid, for sure, by far. And honestly, I think they have the best platform of all of them. Netflix has it on lock, constantly having random FB friends posting about new shows. Yeah, I know they have it on lockdown. When I got Dune TV show and Penguin coming up as well. Yeah. So no, they have good shows. I'm trying to point out, yeah, Warner Brothers and Disney are, completely bifurcated strategies. One has a much better creative culture than the other, but they have the same strategy when compared to Netflix. Netflix is like, here's a bunch of stuff. All right, coming back to it real quick. So what's the problem with Disney and what's the problem with Warner Bros? They both have the same problem. And the problem actually lies in the legacy studio business. So when you think of, your cable, most of you probably are in the demographic that you've already cut your cable. Some of you maybe have not. That's the business that is under question for Disney over here, but also Warner Brothers. And Warner Brothers, on the other hand, has a good amount of debt, which we'll pull up and we'll discuss briefly on the matter. And actually, I want to check out or show you guys the price action for Warner Bros. Because this illustrates, or we can kind of put the story together. So let me show you guys the 6 month. Really volatile. So this drop here, this is the earnings slump. And they come out and basically say, I'm going to paraphrase, the legacy business, we're going to write it down. And it's not as valuable as we once thought. Big write down. Okay, fast forward. What happened here? They reached an agreement with Charter that for the foreseeable future seems to extend the life of their legacy business. Why is this a problem? Why is the faltering legacy business a problem for Warner Brothers? Well, Warner Brothers has a decent chunk of debt, and that means they trade. Let me actually come here. Let me get their filing first. Okay. Share this tab instead. I'll zoom in and we'll go to the financials. Yeah, I just need the balance sheet. Okay, so you guys can see total liability. Yeah, right here, non-current portion of debt. So they've been making inroads at paying this down. 37 billion, not too bad. Used to be way higher, but still 37 billion, market cap 20 billion, decent cash flows. But what did I just say? Decent cash flows. Cash flows is the key word. So the point of, like, a lot of funds will hesitate to invest in certain stocks that have too much leverage. It doesn't matter if we look at the maturity dates and say, oh no, this is fine, this is leverage that they can handle. There's going to be an implicit discount in highly indebted companies because some fund managers will just not touch it. So that is why, if you're wondering, why do these management teams focus? And I was having this conversation with club members last night on this very topic with another stock that I'm invested in that is right now focusing on debt pay down. But you would think, why are they focusing on debt pay down? They could just be buying back stock and not paying down debt and paying a dividend. Well, my rebuttal is no, I understand why they want to pay down debt. They want to expand the multiple, and they think the market's going to expand their multiple after the debt pay down. But I want them to buy back stock right now. Yes, but I don't want the dividend. It doesn't make sense. But anyways, that's a different discussion. So with Warner Brothers, there's no dividend. There's just debt pay down. And so that's where the argument, I think, makes more sense here. You might say, no. Stop paying down the debt right now. Buy back stock and then pay down debt later. Well, under this following context, it may make more sense why they're rushing to pay down the debt now, because they may not have the same confidence or have that much confidence in their legacy business, which, what I just said earlier, under the current cash flows, it looks pretty good. It looks fine. They produce a robust amount of free cash flow. They're trading at what, like 5 times free cash flow. I forget exactly what the figure is. Let me get a quick rough number here to work with. So let's call that 6. I think there's some cash expenses that are going to come online. So let's be conservative and say like 5 billion. So 5 billion with a 20 billion market cap, trades at 4 times free cash flow. Let's maybe lower that to 4 billion, because I think there's actually more capital expenditures, not capital expenditures, but cash outflows that are coming, because it's tough comps, or some of the trailing 12 months are weird because last year was the writer strike. But let's say 4 billion free cash flow, 40 billion in debt. Doesn't seem that outrageous anymore, especially considering, that they have been reducing it, and if they continue to reduce it, it might look better. But remember, my cash flow figure might be a little bit too conservative, because I'm trying to mentally just adjust it for whatever changes that might be in there. If someone has the exact cash flows, I just don't have that in front of me, because I got to go in and kind of redact some things or add some things in. How would lower interest rate affect Warner Brothers Discovery? Very good question. So Warner Brothers, in theory, should actually benefit from a lower interest rate environment, because it expands their optionality with refinancing. Their current their current maturities, I think most of it expires after 2028, but you do have some that are expiring in the near term. So here's a thought. But again, they don't want to do this because they want to expand the multiple. By the way, and Zaslav is incentivized for the price to go up, because that's where he gets his big bucks. But if you think about it this way, you could refinance some of the upcoming debt at lower rates here soon, and then with the cash that you're saving in the near term, buy back stock right now when it's trading at these crazy levels. That's like some shenanigans that management could pull that may actually be beneficial to the investor, or to the shareholder. But I don't think they want to do that, unfortunately. Well, maybe fortunately. It really does come down to how long do you think the cash flows for the legacy business last. And again, just a reminder, the reason why it had 2 10% days in a row is because the legacy business seems to have more life than previously thought. So that's a benefit. That does change things. So coming back full circle, Disney versus Warner Brothers, I think I'm more confident in the creative direction of Warner Brothers. Disney has better assets, but it's mismanaged. And so if management were to ever change for the better, then Disney would be a monster of a business, a monster of a company. And maybe you buy now, hoping and praying that management does change. But as we kind of discussed, I don't know how they could correct the culture there. And that's really the issue. The issue is the culture, and how you uproot a corporate culture like that of Disney. It's okay. Let's go figure that out. Easier said than done. Warner Brothers has the right culture, not the perfect culture, but has a good culture, by comparison, a great culture in place. But both of them next to Netflix, I don't know. They don't really make the cut for me. I just rather keep my Netflix. And debatably, Netflix is at fairish value. Debatably, depending on how bullish you are on some of the forward figures, but debatably, I'm fine with holding it. My cost basis is phenomenal, and there's no real reason for me to let go of it, let go of the shares. So. Doing long term for higher for longer. Listen to Powell's first rate raise. He said what he is doing is for the long term good. As long and rises, pay off your debt ASAP. If the long end rises, pay off your debt as soon as possible. I thought you were saying on a personal funds basis. I was like, my mortgage is like so many years out. I'm not paying that off. But you meant for them. Yeah. Okay. No, fair enough. You do have the risk of refinancing at higher rates, so you may want to deleverage. And there's a good statement, right? Who said it was it? I think Peter Lynch and Howard Marks both said something to this effect individually. Well, most of the super investors we all listen to for words of wisdom all have said something to this effect, but no company has ever gone bankrupt with no debt, right? There's some form of debt that causes you to go bankrupt, some form of liabilities. So in general, having no debt is less risky than having a ton of debt. Of course, I'm stating the obvious. So yeah, just because the short end has come down, who, if any, talk about the long end? No, but the long end of the curve has been coming down. That's the thing. So the long end of the curve is more in line with projected or theorized forward growth rates and inflation rates. And so it's pretty muted. So we may be entering a world where there is lower inflation, what people, come to realize. Because inflation and money growth is going to come from the banking sector, the financial sector. And if there isn't an appetite to lend, you're not going to have lending growth. You can look at, the likes of Japan as an example. But a lot of people simplify the American version of the financial system and the Japanese one to equate it to that of, countries like Venezuela, where you can literally print money. So it's a bit more complex than that. But yeah, so the long end of the curve is showing that we're probably going for, lower growth, lower inflation. So that's going to be good for some things, bad for other things. But yeah. Do you think Warner Bros. Is attractive long term? So I have, I'm not going to hide this from you, Rob, or I don't know if you're in the club or not, but I do have a bullish exposure to Warner Brothers via puts. So I have contracts that expire in December of 2025 at a strike of $7. So that's the extent of how I'm involving myself in Warner Brothers. I may elect to do more, less, because there was a deep concern after the last earnings report, but this new developments I think are actually material to the positive. And so there were some more bullish Warner Brothers individuals in the club. I think some of them did get shaken out on the last earnings because you didn't know. There was no way to know that these recent developments were going to come. There's impossible. You had to have insider info. And I don't think the management knew either because they wrote down the asset. They wouldn't have written down the asset if they knew what the terms of the charter deal were going to be. And it's not like it entirely saves them. It just delays the inevitable. So, yeah. Okay. Fuhat saying Warner Brothers is garbage. All right, let me adjust the timestamps real quick, and I'll talk about what to avoid, or what are things I think you should avoid. It's just my opinion. So some of the things that I think should be avoided right now is anything regarding the consumer discretionary stocks, because I don't think we're out of the woods yet. So my co-host and I, Andrew, who's in chat here and there, I think he's working right now. So he gave let's say, let me actually pull this up. Let me try to find where I stashed this. Oh, you know what? I'm going to invite him on. I didn't see my messages, and he said he's free to come on. So I sent him the link. He might come on any second. But he sent me some interesting info, and Fuhat is going to appreciate this because he loves this sector so much. I have to find where he put all these charts. Let me see where they are. Oh, found them. Oh, I can talk about this. I can talk about this in a second. Actually, while I'm pulling all these images up, I can talk about it simultaneously. I can multitask. So, so Paul recently came up with a live stream, and he said, "Oh, I don't need to take on unnecessary risk. Why risk what I don't need? So he's referring to the fact that he's a Chad. Y'all are brokies and don't understand him. Wagey, get in a cagey kind of stuff. And he's like, I'm better than you, so I'm going with SCHD because I don't need to outperform the market anymore. And all I heard from that live stream, the little that I watched, because I can't really stand watching too much of Paul, is you got a lot of coping and seething because he's a clown who underperformed massively in a bull market. Just for the record, let me restate this. If your general strategy is value oriented, and you claim that the day of reckoning is coming, as soon as we have a bear market, you'll all see what it's like, haha. And then bear market happens, you underperform, then bull market continues, you keep underperforming. Not only that, you go negative because you shorted one of the best performing stocks in the stock market of that year, which is Nvidia. That's Paul. So, and then Paul is the epitome of unearned arrogance, because it'd be something of like, he's super arrogant, but wow, his performance is like really good. And so, okay, let him be cocky and arrogant. Because I can't say anything about it, but the guy's terrible, frankly terrible. So this retreat into SCHD, that's him waving the white flag in a way. And I'll be fair with him. That's better. That's honestly better than him making the decision for his money. In fact, I think 100% of his investments should be out of his hands. He is not mentally fit to invest. He also stated that there's a clip that was hilarious. He's like, I'm not a good manager, but I'm a good owner. I'm like, the hell does that even mean? So he's referring to his 8 or 9 businesses that he has upstairs, because he said he used to be more involved. And then he found out that he's not a good manager. He's a good owner. And I'm like, oh, so you suck in every aspect of business. Like you're just good to just have spawned with money, and then you put money in, and then if it doesn't burn, great. That's your skill in life. And because like with investing, you're talking about a skill of capital allocation, which is, that's a skill you can hone, develop, etc. But there's not too much difference of managing a private company and capital allocation to public companies. There is a difference, but the principles are not that different. If you're running the company as a CEO, CFO, you're managing the capital of your enterprise, and you're making on a daily or weekly, monthly basis decisions that are allocating the capital of your firm into projects, etc. And you're making things more efficient. You're managing a portfolio of assets, but not in the way you might think of traditionally as you look at stocks. You have a portfolio of assets. You have all this inventory you're managing. You have maybe a warehouse portfolio that you're using, but you have a warehouse portfolio. Maybe you have other forms of real estate in the business for whatever reason. So at the end of the day, you are managing a portfolio of sorts, assets of sorts. And so it's not that different. There is a difference, but it's not that different. So what he's basically admitting is he's just bad. So that's my quick rant on that. Hope that fully that's to your satisfaction, Internet Dog. But I think that's him waving the white flag, and I think that he should honestly go 100% SCHD at this rate, because it's better than whatever he does. Okay, so let me share or start discussing what Andrew shared with me. And if you guys don't know, Andrew co-hosts and analyst at Capital Mindset. He comes on a lot of times. Most of the time, actually, he's on. He might come on later. I sent him the link, but I don't know if he's with his wife or something. So Restaurant Performance Index. Let's talk about this. So I watched an interesting video from one of my investments. It was one of their, random public relations videos, but it was one of the co-CEOs. And he made a discussion point. It was months ago, but I rewatched it recently. And months ago, he said, hey, we're not seeing, I'm saying months ago, we're not seeing a lot of weakness in the economy. Typically you see weakness in restaurants. And then I sent that, when I sent that video to Andrew, Andrew comes back and gives me this. And I'm like, oh, this is interesting. I didn't see this yet. The Restaurant Performance Index. Well, what do we have here? So we have here a chart that shows, again, the restaurant performance according to the National Restaurant Association. And you can see from the chart, as I guide you through it, values of greater than 100 is expansion or growth in the restaurant space. And then values less than 100 is contraction. It kind of makes sense because greater than 100, 100%, that's growth. And then below that, it's decay. So we had 3 points of decay in the past 20 years. We have the 08 recession, we have COVID lockdowns, and we have just now, starting now. So what are we supposed to make of this? Well, restaurants are, let's say, the frontline warriors in the economy. They face the recession head on and are defeated or succeed. I don't know. Glass half full, glass half empty. But we typically start to see the pain there as far as some industries goes. As far as consumers goes, because we talked about consumer, you see it at the low end. Well, we're seeing a lot of things, and the topic of this segment is what to avoid. Well, it seems to me that the avoiding would be in the restaurant space. Asterisk on that. Right. And well, actually, let's elaborate on that asterisk. What is that asterisk for? It may be actually an okay time to buy, but it would have been a good time to perhaps avoid, depending on how bad the restaurant space gets. So some restaurants, like a McDonald's, they may be shielded from the effects as far as stock price goes, and they might suffer as far as the business goes. What have we been seeing? We have to push a value-oriented menu. What does Starbucks say? We have to push a value-oriented menu. That screams the consumer is rejecting prices, rejecting consumption. There's demand destruction to some capacity, and they're having to reorientate their strategy to provide more value, which makes sense if we're looking at this chart. And then let me share some of these other ones that he shared with me. So this is another one. So restaurant operators reporting of same-store sales versus same month in prior year. As you can see, the data continues to be negative. And so across all these, basically, I don't know if I'll show you all the charts, but let me just say, for all of them, they point to restaurants going through a turbulent time. So depending on your outlook and how you view things, you may think, okay, this is the time for me to start, if you're interested in restaurant stocks, start a watch list of restaurant stocks or restaurant adjacent stocks, and pick out some ones that I'd like to buy if the market were to sell them off, or if they currently are selling off. Some of them are not selling off and some of them are. So, let me throw up some tickers, I think, and I haven't looked at these actually, so I have no idea how they're performing right now. So Cheesecake Factory is one that comes to mind. So they're doing okay. And then there's DRI, which is Darden. They're doing okay. TXRH, should be okay. More than okay. Well, they're flat for, I'd say that's more than okay. They're doing better. And then we have the other end of the spectrum, Red Robin. I guess I'll put that. Yep, there we go. Red Robin. Now, these guys might go bankrupt, right? 5 days from now, like they rallied with the Shitco rally, but yeah, these guys might go bankrupt. What is it? Cracker Barrel. How are they doing? And let's see them. Okay, not so hot. Let's look at a few more. So you can see it's split across the board. So I always forget QSR. How are they doing? Okay, not so hot. Fine. And then let's see. Not so hot as well. All right. I'll throw up Wingstop. Thank you for reminding me, Fuhat. Phenomenal. Wow. Crazy. So all in all, the restaurant data, and keep in mind, this is looking at all restaurants. I just threw you some like mega co's in the restaurant space. Those are all big companies. So this is all of them. And so some of those mega companies can do well, and some of the local restaurants can do poorly. So keep that in mind. But it could be, oh, you're into that kind of thing, or adjacent businesses. Keyword on adjacent. One of them that comes to mind is Toast. You know, Toast is a company I have a strong affinity for. I can't explain why. I just like what the company does and addresses, and I think they have a good culture there. But you know, they're going to be heavily impacted by the broader restaurant category because they service a lot of the local restaurants that you go to. Not so much the big, large mega chains. They'll focus. They don't service a McDonald's, but they'll service, like, you know, you go to your local cafe. There's probably Toast. You go to your, you know, whatever you think of in your mind, the local blah blah blah, probably a Toast. I need to load on Toast but they need to dip below 19. Hell yeah. And I know, yeah, Kava's on a tear. Kava's the next Chipotle. Oh yeah, Din is the other one that's doing really well. They're the owner of Chili's, and Chili's is doing really well. But Chili's, look at what they target. They target that middle American, value-oriented customer. And in a time like this, where everyone's kind of shifting towards value, those names are doing really well. They've maintained their value proposition really strongly. CMG has also done really well because they've also maintained their value proposition. If you look at the average Chipotle bowl, you know, for chicken in most parts of the country, $10, a little bit over $10. If you're in an expense part of the country, a little more than that. But for the most part, it's a lot of food for not that much of a price. And so Chipotle's maintained that value proposition. Kava, same thing. Yeah, these are some of the adjacent companies that I was alluding to. Yeah, Brinker. Everyone's talking about Brinker. CNBC has been talking about Brinker because Chili's is killing it. Toast my boats. Yep, exactly. Oh, yes. Tupperware filed for bankruptcy. Rip to some investors who owned it. But yes, Tupperware filed for bankruptcy. I mean, I didn't understand why someone would want to invest in it. It was like basically, was it? I think it was like an MLM of sorts. Yeah, it's kind of a crappy company, to be honest. Weird company to say that's what I want to buy. But yeah. All right, so the next point of discussion, we talked about what likely to avoid. Oh, no, let's actually elaborate more on that because I didn't get into some more interesting stuff. So anything that's levered consumer, what I mean by that is anything that's high discretionary. I think Boba, the dog, asked me about cruise lines. How does it affect cruise lines? Because nothing's coming true. So that has yet to be seen because it does depend. So cruise lines, I think, is going to be a bit bifurcated with different kinds of consumers. The market may be right. Well, the market tends to be efficient over a long period of time. But the reason why I think Royal Caribbean is getting a nice premium is the customer base is different. And that customer base might end up being more solid. Because I'm starting to think that if we start to see further consumer cracks and discretionary spend come down, and I know that cruise lines, they've seen a lot of demand recently, and that's kind of boosted their spirits, and they've been able to try to push for prices. I'll add to this comment: low-end consumers still stressed, mid-low consumers will be key. If they can hold for a while, the Fed cuts, and don't lose too many jobs, we might come out all right. Time will tell. Absolutely. But on to that point, that's going to be that consumer that we have to pay attention to with something like Carnival Cruise, the lower side, because that's what Carnival, the brand, caters to. And Royal Caribbean tends to be like more down the middle. And then they both have high-end brands, so they both cater to the high end as well. But for Carnival, the majority is going to be from their Carnival fleet. And then Disney doesn't break out theirs, but Disney is also backed up. So I think as a travel option, they're poised to do really well. I could see them doing well. I'm going to be honest with you and say, if I felt that you were likely to lose money, I would tell you. For example, people who invest in SoFi, I think longer term, that's either going to be dead money or you're going to lose money. But I could see like a Carnival working out. There are ways it does work out really well. But I don't see that with some of these other stocks. Same thing with like when I'm asked about PayPal. Like PayPal doesn't excite me. It doesn't get me to say I want to put tons of capital into it. but I can see it working out. So it's not like to be kind of comedic with it. It's not a trash tier investment. So I played my Stilton Carnival. You recall from the live stream, I think I played that earnings phenomenally. I did a synthetic long position, so I don't hold it because I unwound it, and we did like a celebration live stream after the fact. But the way I played Carnival's earnings back then, and I was going to just say that I was expecting Carnival to report an increase in passengers, and that's what happened. And so what I ended up doing is I sold long dated puts and I bought short dated calls, and then I got a pretty nice return on that, you could say. But so it's a bastardized synthetic long there. So then I profited on both legs, and I was able to close my my calls, I think, at just over 100%, and then the puts I closed them at like a 31% profit, something like that. So, and if you're curious, the strikes, so the strike on the call was like 13, and then the strike on the 13 for like October, and then the strike on the put I think was 2026 for 17. So it was basically at the money. At the time it was, well, no, sorry. At the time it was out of the money. It was slightly out of the money. What happened to the 10x SoFi guy? Well, yeah, he's selling course 10xing stocks that he hasn't 10xed in or proven to have 10xed in. But he's selling courses teaching people how to 10x. So, nothing's really changed. Very vague about, his stock purchases, etc., stuff like that. Even if you buy his course, you won't really know. So you got it's a trust me, bro. And then if you ask him for his percent return, he's going to hit you with the I don't want my friends and family to know how much I have, so I can't show you that. It's like the broker just shows the percentage. I mean, you don't have to show the dollar figure. So yeah, Chili's is OP. I haven't been to Chili's in a long time. Remember when Tup ripped? Well, I don't remember that. I haven't been paying attention to Tupperware. Time to sell on Amazon. It's Jover. All right. So I think we're getting to the last topic, which is what will look interesting. And let me go ahead and change the timestamps to the correct one. We're mostly good on these timestamps. We mostly follow the schedule. All right. So what are some things that might be interesting? So let's start with the more obvious. And when I say the more obvious, the things that we pitched within the club that have been working really well. I'm going to talk about themes. I'm not going to talk specific names yet. But the themes are, you want to go for it, or you would have wanted to go for things that were very dislocated from consumer stocks that are companies that I hesitate to say safety trade, but I'll say safety trade. I'll say one that I've already talked about publicly, like British American Tobacco has done really, really well because you had a couple tailwinds kind of culminating into one strong thesis. You had the safety trade consumer staple. Yes. The price point that it was trading at was phenomenal, gorgeous. It was trading at basically a level where you could imply decay in the underlying earnings and it could still work out. And in fact, earnings are growing. And then it's even cheaper than what people think, because if you factor out India tobacco ownership stake, it's crazy cheap. That's the one I complained about earlier and I alluded to, because there's a live stream in Capital Mindset where we talk about how much I hate the capital allocation policy of BTI and how they're literally choosing to make less money. Best fast casual restaurant not as an investment. Ooh. Okay. Value for what? I'm going to give you two answers. Overall, Chick-fil-A. But value for what you get, definitely it's got to go to In-N-Out. In-N-Out by far. Because when I went to In-N-Out for the first time, my jaw dropped at the price. I think I jokingly said like this food has to give you cancer or something, because it's like, it probably does, but I said it as a joke because I'm referring to the like how can they make it that cheap? How is it that cheap? It's just doesn't make any sense. It's so cheap, and then you get a lot for that. So yeah, but those are my two answers. But anyways, coming back to the topic at hand, yeah, BTI safety play stocks were a way to play it. There were other stocks that had tentative correlations with where liquidity would go. As a broader space, one that's done really well for us is private equity. REITs have done well. And yeah, some niche financial ones, but we won't get into that. But yeah, just in general, broader theme, things that are disconnected from consumer or to consumer discretionary, as far away from that as you could possibly get. And that's the ideas that have worked well. What will work well? I think there's going to be some momentum and continuation of those themes. I wouldn't be surprised if we see that. And then some of the newer themes that might come about is also kind of a switch into some consumer discretionary. So I'm thinking of stuff in, like luxury goods. Luxury goods might be something that ends up looking interesting. There's one problem, for example, let's talk about the big one, LVMH. So there's LVMH and Hermes. Hermes has a better brand, in my opinion, but LVMH has better regions because Hermes is heavily exposed to Asia, excluding Japan. It's by far their largest region. And then LVMH is more diversified evenly across, Europe, North America, Asia. It's a bit more diversified in that regard. I think that when you kind of look into the beauty segment, talking about LVMH and Sephora, you have Ulta and Sephora that I theorize would do fairly well. In consumer, I think e.l.f. could turn out to be really well, but the pain is understandable because everyone's doubting consumer. Although I think that's misguided, and I think that one, the baby was thrown out with the bathwater. But that's exactly what you pay for when you pay for a stock that's trading at 50 times earnings. Any little question in the story, down she goes, right? It makes a lot of sense. So, didn't you like Dow and LYB? Well, Dow and LYB maybe are going to look interesting now, Waffles, because those guys will tend to bottom first in a recession. In a traditional recession, you kind of see, and this is all historical, but so things should be different this time. But those guys see the brunt of demand destruction, the initial drops, and that could be one way to start exploring and seeing what companies are there that are presenting interesting value. I feel like there's some that would be more interesting if prices got really crazy in the chem space. If you're in the club, we can chat about that maybe on one of the ICOMs. You can ask. I think you're definitely a club member. Energy drinks, Monster already turning around. Yes. So, damn, I'm calling you out, Andrew. You capitulated too early. Look at this, 52 already. No, but I think Monster's business, it's recovering ahead of the business itself recovering, and the rationale behind that is people are thinking, hey, what do I get here? I get consumer staple that grows faster than the other consumer staples, but consumer staple. And Monster even said in their last earnings, we don't see these kinds of drawdowns unless we're in some sort of recession, implying we're in a recession. They didn't say that, but it kind of implies it. So yeah, this is something that you could have gotten into, but this is like part of that consumer staples safety trade, so to speak. But I think that if you see any opportunities in the themes that are still showing earnings growth, there's no reason to fall astray from those, and then just stick to what you know. So I know that's like the cop-out answer almost with this, but there have been themes that have worked up until now, and I think those are going to continue to work, the ones we discussed at the beginning of this segment. But the things that might be later down the line will be a lot of that consumer discretionary. It's going to get thrown out right here. Retail's a bit shaky because I don't have the confidence to go into something like a Dollar General. Because retail, it's never just one bad quarter, as Druckenmiller says. It's going to be multiple. Monster or CCL. There is the totally different. Monster is a consumer staple. CCL is discretionary vacation. So CCL will do well in the like a Disney parks doing well in that sense. If people want to spend on vacation, they're both going to do really well. Do you consider Hermes to be higher risk, higher reward? No, I actually consider it to be probably lower reward, probably higher risk of something going wrong. You're paying up for the Hermes brand. So Hermes is a better. I actually do have the concern of Asia, but if you don't think it's a concern, Hermes is a better brand. It has better pricing power. It's actual pure luxury. Akin to that of Ferrari, ticker symbol race. They're within like the same level of luxury. So Starbucks and my only staple. Yeah, no, Laker. I mean, if you don't have another idea, are you bullish on cruise lines now? It's hard to say if I mean, you might have left the stream. I answered your question earlier about the cruise lines, but I'll summarize it. So I'm indifferent to it right now. The way I played and profited from CCL, I think was good enough because it was a decent return. But I haven't even seen what CCL is even trading for these days. Okay, so it's basically gone nowhere, but slightly up. So it's recovered from this dip over here, the yen carry trade. So I can see it working out. It's just not something I'm personally, rushing to the door to buy shares of. I'm focused on some other names right now that I think are gonna do really well. No, Lululemon is definitely not luxury. It's just expensive, but that's not bad. Like, being expensive doesn't mean you're low quality. Like when I say you're not luxury is not quality, but it's not luxury. Luxury is aspirational to the fullest extent. So you don't buy it at all for the improvement it makes on your life. You buy it for some other thing, and the pricing power is immense. Lululemon can't just charge whatever it wants. Hermes can, Ferrari can. They can charge whatever they want. There's people out there that buy that stuff. So RH, I consider it expensive. Restoration hardware, expensive, not luxury, because it's not difficult to attain. You have the money, you can buy it. What mega cap benefits the most from rate cuts? Probably, if I'm being honest, probably Amazon. Amazon and Meta are probably the two that benefit the most from rate cuts. The way I'm making that judgment is like which of the two businesses have the greatest reinvestment opportunity, and that's probably those two. So, because Google would actually probably be neutral to. I think it's just neutral for them. We're kind of stretching. I think rate cuts are a neutral factor for both of them, for all of them. Sorry, except for Tesla. But wait, did you say Mag 7? Oh yeah, your question was mega cap. So Tesla isn't mega cap. Because I hate the Mag 7. I think it's Mag 6, if anything. And even then, it's like, this Domino's pizza is about to go hard as I haven't had Domino's pizza in forever. Any other company in that tier of Hermes and Race? Great question. To my knowledge, yeah, Porsche is a mixed bag. because Porsche has attainability and luxury within it, but it's not the same level as those two. There's a lot of private companies, but yeah, I can name some private companies, specifically in like the watch space as an example. But you have some brands in Richemont, which LVMH may acquire at some point. That's going to be luxury, like Vacheron Constantin. It's one of the three horsemen between Audemars Piguet, Vacheron Constantin, and Patek Philippe. So those three are definitely in that tier. They can charge almost whatever they want. They have the clientele that will pay it. They are not meant for the average Joe whatsoever. So like, again, there's like an expensive watch that if you have the money, you can buy it. Then there's the brands that there's something more to it. Rolex is getting there. It's trying to get to that same level. Have we talked Jay's interview on our favorite specimens channel yet? No, not yet. I haven't discussed it, but I think he was surprised to note that there were a lot of people that go all into his funds when he doesn't even recommend that. Will Costco ever dip? No, Costco is just going to multiple expand into infinity. That's what we've concluded. Domino's Pizza everywhere else, but Domino's in the hood is popping. Just my experience. Well, if I ever get Domino's, I'll think of you, Internet Warrior. Just with those brands, I don't know. Well, Domino's is cheaper, but I like go to the local pizza shops. Much better usually. Tobacco has outperformed big tech over 25 years. Has it now? Well, yeah, 25 years you're including .com, right? Yeah. But I think tobacco could outperform for the next 25 years if they just did freaking buybacks instead of dividends at these multiples, and then just have a flexible dividend. Just go like, we're trading at this low multiple, buyback stock, no dividend. Oh, now we're re-rated, dividends. If they did that, you would have outperforming returns, at least, for big tech for sure. You'd crush them probably. Like if BTI had freaking said at $28, guys, we're cutting the dividend and we're doing crazy amounts of buybacks, and the stock drops because they dropped the dividend, oh my gosh, you get even more yield on those buybacks. Oh, that's such a fumble. You have no idea. That's such a waste up. You know how you say like one of the worst things is wasted potential? That's the definition of wasted potential. You guys have no idea the outperformance BTI would have if they had done that. Imagine you wake up as BTI CEO. I would take the job only to change their capital allocation policy, get my stock-based bonus and dip, and you guys just watch. Run everything as is. Change nothing else. Operationally, capital return policy, change that up a little bit. Completely different story. Completely different story. So, yeah. No, I promise you, it would definitely destroy a lot of your favorite stocks' returns. Reformed capitalist. Were you a communist?
Can you hear me?
Yeah.
Okay. Sorry, I think it's actually an internet connection issue I've been having. Now, I thought it was my computer at first, but in another place, my computer's fine. So, but you can see me too?
I can see you.
Okay. It's got like a black box where I'm at right now. So, okay, there we go. How's it going?
It's going good.
What you guys been talking about?
Everything. I've gone over every topic now.
Really?
Yeah.
Okay. Did you talk about why rate cuts are gonna be bad for banks? Like their cap. So okay, so we can talk about that later. I don't want to rehash it on this.
No, let's rehash it because there's people that join in. They didn't watch the beginning because I talked about in the beginning. So a lot of the people watching now, we have 157 people, and some of them came in,
okay,
later.
So the question I had for you was, I saw Walter Bloom Bloomberg, I don't know like what he somehow became like the news guy for like federal market or for stock markets. He said that Moody's said that initially U.S. Federal Reserve rate cuts will be credit negative for most U.S. banks.
Mhm.
Okay. So my only thought is a couple things. Well, one is it just because it's a shortening duration, which is an issue for them because they're underwater already?
Shortening duration because what? What's causing the shortening in duration?
Well, because it could lead to shorter term, because this will affect near term
Mm-hmm.
rates more than long term, right?
Mm-hmm.
And so,
But no, it could imply that long-term rates are going to fall even more.
right.
Yeah.
And so, my only thought was one of two things was people in like because there's a lot of businesses and well, there's a couple things. One is if the banks have, because they loan long,
Mhm.
they loan long and borrow short, right?
Yep. But what's happened recently? We've been inverted. So then they've
Right.
been,
Borrowing short and
but
have them
they
gone out in duration?
they've been so like they're not like buying long-term treasuries and then lending out at short-term treasury rates. That'd be insane. But their net interest margin was compressed. What I think he's referring to and what I addressed earlier was that when you have rates coming down and it's going to stabilize afterwards. So it's not doom and gloom. You have the risk that a lot of your portfolio might start to refinance on you. And you're going to be churning your portfolio up at lower rates.
Okay, so that's kind of what when I said the duration shortens, that's what I meant, is that you have refinancing.
I thought you meant like you're going from an average duration of like 25 years to now 7 years. And I'm
No,
like,
I meant like the loans you're already underwater on, the duration on those is now shortening.
Yeah.
Okay. So explain it. Okay, you can explain in better terms because like I'm connecting dots, but okay, I think it makes sense now. So actually, I'll spit it back and you tell me, Andrew, that's right or that's wrong.
Yeah.
So I am borrowing from your bank, and what happens is I get a mortgage at 7%. And what happens is as rates come down, actually, let's just say I got a mortgage at like 5% and you're underwater on it because rates went down, or it's 7%, doesn't matter. So we're just gonna say, as rates go down, I then come to you, and most banks are already underwater, like equity wise.
I can't get rid of your mortgage. Yeah, I can't sell it. If I sell it, I lose money. Yeah.
Right. But I come to you and say, okay, now I'm going to refinance it from 7% to 6%. So for you, that's credit negative as a bank because you as the bank just lost 1% in interest per year.
And then now, if I refinance it with you, or you go to someone else, if I say no to you, you'll go to someone else because it's a commodity. Right. But yes, yeah. Now my portfolio will have lower rated loans, which is inherently a risk because there's less leeway for things to go wrong. Risk is implied in the interest rate. If my interest rates are lower, I'm implying that there's less risk, but is there really less risk? No. So if I have a massive portfolio of mortgages, let's say I'm going to give you a whole portfolio of mortgages, all yielding 2%. You have one risk that you don't have to think about, which is refinancing risk. These guys are all going to probably hold it forever. That's good for you. You'll like that.
Well, I don't think that interest rate implies risk. I think spread implies risk.
Well, yes, spread implies risk. But if you're, generally speaking, if you're dealing with the borrower that's higher interest rate than lower interest rate, that's implying that there's a
yes. Okay, continue.
But and then the spread you're talking about between asset classes, right? So it's like a mortgage versus a credit card loan versus a car loan, et cetera.
Versus treasuries. Yeah. I mean, yeah.
So if among the equal assets, mortgages to mortgages.
Yes.
And I am a mortgage lender. If I get a new portfolio, I had a portfolio yielding 7%. And now I have a portfolio yielding, let's be extreme, 2%. It's the same assets. It's the same real estate, mortgages. The only risk that's gone away is probably the refinancing risk. A lot of those loans, they're never going to refinance. I've now introduced 2 new risks. Duration, because if rates go up, I'm stuck with them. I can't move this money around. I'm stuck with it.
Yep.
And so that's liquidity. That's a liquidity risk. Then the second risk is, well, among defaults, why are credit card rates so high? Because there's no collateral to take from you. So the bank is compensated by taking on that risk with higher interest rate. With mortgages, you're compensated with the interest rate. That's your earnings. And if the loan goes afoul, you have, the house. I think maybe the wrong example is to use, maybe cars is a better example, because housing is the lower risk loan type. But either way, if more of your portfolio goes red, your average interest rate, if your average interest rate went down, you still can get in a total basis underwater. Like if you're only earning 2% on the portfolio, let's be extreme with it.
So
is it really, has the risk gone down between 7 and 2%? Same asset. I would argue no.
No, it hasn't, which actually makes it interesting, because humans, I think, are really bad at long-term, even like within the context of working in a corporation, are really bad at long-term. I don't want to say vision, but like mindset, where like, so if you think, going back to 20, let's say we had another situation, and I don't think rates are going here. I don't know if you talk about this. Rates go back, the SOFR goes back to like, what was it at, like 0 to 0.25?
Yeah, it was ridiculous. It was basically 0. Yeah.
Do you think that spreads on mortgages would widen from the Treasury? Do you think banks would be willing to go down to 2.5% again? Because
not all banks, but the desperate ones, yes.
Because
it's a prisoner's dilemma. You're all looking around at each other, and one of you is going to do it.
Could you take interest rate hedges? Would you just?
I mean, you could, but at the end of the day, you still are going to end up, broadly speaking, with a greater quantity of like lower rate loans. Which, if you're going to hold forever, good for you.
Yeah.
But
it's just because, like, I don't, because I think there was 2 things that happened, right? Is we were in super low interest rates for so long. And then it went down to 0. And the banks were like, okay, this is just like, they probably were just kind of getting like lulled into it. And then rates just ripped on them, and it just tore a hole in their balance sheet.
Yep.
And yeah, I don't know. Like,
and the Basel III regs, we're talking about the wrong product type. The Basel III regs are interesting because they have limitations on the effects for mortgage products, which means that it's supposed to encourage more ownership of mortgage products, but it would discourage other kinds of lending, which is really interesting, Andrew, for certain companies out there that fill in the gaps. For those entities, there might be more business, not less.
Oh, really?
Yeah.
Oh,
yeah.
So Fuhat's all bricked up. That's what you're telling me.
Yeah, Fuhat's gonna be super bricked up. But
so that's interesting. Also, it's very interesting that there's no regulation within that market, is there?
No.
It's such a small market, though.
Yeah, it's such a. Oh, I don't know why this came up.
What is it, back, please?
No, I was trying to pull up Bank of America.
Yeah.
Because this is the bank with like 25-year duration issues. So it's like that's what their average duration is. So, I mean, rates coming down can finally, breathe in some liquidity into Bank of America. It needs to come down more, though. It needs to come down more. No, because they can't get rid of a lot of their loans.
Yeah, but the reason I'm wondering this is like Buffett has held Bank of America for so long, and now as rates are coming down is when he got out. So like, I almost wonder if there's like something that we're not thinking about that's negative about this for Bank of America.
Well, if
I mean,
had,
like I can't read his mind, so I don't know why he sold, but I would imagine like you wouldn't want to sell if you think there's about to be a big bullish catalyst for particularly Bank of America.
if I had to guess, there's probably two things that we can attribute to Buffett selling: the concerns we listed earlier, and to some extent, he's probably preparing to, not to be morbid about it, but he's probably preparing for his death. And so I think I've talked to you about this. Like, he's maybe even selling not for the reasons people think, but he's trying to unburden Todd and Ted so that when they are in control of all the money, they don't have any of his legacy positions. Some of them, not all of them, that they'll be like hesitant to reallocate that capital.
Yeah.
It's like, oh, that's the Buffett pick. We can't touch that.
Mm-hmm.
He doesn't want them to feel that way.
True. And just to be clear, I see some comments saying that we're assuming. I don't think Fabio or I are assuming that we're going back to zero interest rate policy. Like, I think we both think that like SOFR probably settles somewhere between 3% and 4%.
Mm-hmm. Yeah.
And that's kind of what the bond market's saying. But 3 to 4% SOFR is a pretty large drop from where we're at today.
Mm-hmm. And we're going from 5 to there.
Right. And then Citizen of the Year, something that was interesting. He said, "Are we cutting rates when inflation is not even solved?" I think it's actually smart to cut rates right now because I think it's been restrictive enough, and it's going to take time for the cutting of rates to actually move through the system, I think.
Mm-hmm.
And actually, Powell was saying that inflation was at 2.2%. I don't know what inflation he was talking about.
But remember, I think we're all forgetting over and over and over again. There's like two primal drivers of inflation, or to be more, I should use the word primordial drivers of inflation. So you have cost push inflation and demand driven inflation. The rates one is not going to be cost push. Cost push is what we've seen recently.
Give me 1 second.
Oh, no worries. So I'll continue to go on. So like, I think we need to apply the nuance. So if you have cost push inflation versus demand driven inflation is the one that we attribute to, rates being where they are low. But I alluded to earlier that in order to see that, you need to see the demand on both ends or both parties to play. Within the financial sector, you need to have parties that are willing and able to lend. And then on the other side, you need parties that are willing and able to borrow. Then that's how you can get more money flowing through the system, more transaction activity, et cetera, et cetera, et cetera. So that's where you see the demand push inflation. Then you have cost push inflation, which can occur due to restrictions in supply for a given commodity. So like, for example, we have drop in production in oil. It causes oil prices to go up, and then cost push inflation and input cost has increased, and therefore prices of the products have to increase in order for companies to maintain or not completely destroy their margins. You could have like a spiraling effect that often people talk about with, wages. Wages is a form of input costs, and that could drive cost push inflation. So it really does matter, and it makes it more complicated, but that's the beauty of it. It is more complicated than what appears on the surface. The inflation issue, we need to ask ourselves, what is the primary factors right now? Is it demand or is it cost push inflation? Like what's the cause? And what we were seeing from the data, I mean, like, a lot of the data, remember, some of it is lagging. And so we don't really see the full effects until later. And we see unemployment starting to pick up. So that could be a sign to come. And we were just talking a while in this live stream about, certain portion of the consumer weakening. We may see that travel upstream to the middle class. And if we start to see that, you'll see not, again, 2008 level, but we'll see some demand destruction. And that's going to be a negative drag on the demand side. So you're going to basically be relying on inflation from cost-driven factors, which I don't know, Chief. Supply chains are still out of whack, but they're getting better. Dom's also right though. That is one component.
Oh yeah.
If government spends a lot of money, that could drive the demand side. So, you guys remember aggregate demand, aggregate supply. Aggregate demand is stimulated by government spending. You guys remember your econ classes. But yeah, aggregate demand can be stimulated by government spend. Government can borrow money from the financial sector, so they can try to fill in as that willing buyer. But then you have the very beautiful effect that is observable in some markets. Oh gosh, what is the term I always say? It's the drowning out effect. Government spend can drown out the private borrowing.
Okay.
And that's a problem that people don't like to talk about because they like to ignore that it exists. Because if I just borrow an incredible more amount of money every given year, maybe financial entities start to say, yeah, I don't want to lend to Andrew. Andrew wanted to borrow from me to start this like ice cream store. I don't know if I want to take on that risk. I can just lend to the government.
Right.
It's whatever. Sorry, Andrew. It's a no. But then you have private equity that comes in and is like, hey, Andrew.
we'll loan to you, but we get a royalty and it's at 10%.
Yeah.
It's like an equity stake. But
thank you, Sarah, on the crowding out effect. Yes. So government spend can help up to a point, because then it could also hurt things on another side, which Japan. Literally,
though. Japan's such a unique situation, though. I feel like.
No, but United States, give it. Let us borrow like mad, and I guarantee you'll start to see like that. You'll see initially stimulation,
right,
and then on the private sector side, so you see public sector push a lot more. Private sector will push a lot less.
So, and that's one of the things I think we've talked about this. It's actually, so one of the things I think that's been bad, and I don't know, we're getting into macro talk. I don't think we need to go too far down this maybe, but one of the, maybe I would consider like negative things in some sense. And maybe you're hinting at this a little bit, but one of the things that the government spending, an extreme amount of government spending, as well as Federal Reserves that are flattening out business cycles, is it does one of two things. It takes away, it has the crowding out effect. It takes away investment into private institutions, or what happens is it allows investments, because interest rates are so low. So there's so much capital out there that risk is a lot lower, to invest in companies that really should never exist. And in having a business,
zombie companies,
in having an actual business cycle, you get rid of the garbage. One of the things, and like, this is going to sound really mean, but we've had like record high bankruptcies in the last year. And it's because it's a lot of companies that were established and money was free and they had no purpose of being around. And so I think in a way that's very healthy for an economy. It sucks. It sucks for the people working. I'm saying like it's good for companies to go out of business, but in a healthy economy, there's people have business ideas. They try the business out. And if the business is economic value and is executed well, it lives. And if it's a zombie company, it dies. But what we've allowed is, through government stimulation, as well as in some cases low interest rates, is to allow those zombie companies to live. But that's just so I think in some sense that's good. That's why I think, I don't know if 3.5 is like, I don't know what's the ideal healthy. I think right now we're clearly restrictive, but that's because we're coming off such a low base for 15 years. It's hard for an economy to adjust to that. I don't know what the healthy like normal rate is for interest rates. I don't think anyone does. I think it's probably dynamic.
Yeah. I mean, it's a whole other monster that the Fed doesn't even control that much. So
Do you remember one of my favorite things though, when interest rates, when it was first rising, and people were saying like, oh, like this is crazy, we're raising rates so fast, and all these things were coming out. I want to say it was Bank of America released a research report, and it was showing like, and it went back like supposedly something like 3,000 years of interest rates.
yeah.
And it was like, I was like, what did they go? They went to the Codex of Babylon and were like, oh, what were interest rates? It was pretty funny.
Wasn't it that we're like a little bit above the average?
No, it was, yeah, basically what they were saying was zero interest rates is like unheard of. And we're just returning back to historical norms.
Yeah.
Yeah.
Zero rates. Yeah. I mean, because it's not zero rates for us. Zero rates for the federal funds rate. But
yeah. Well, and there's a spread on that and all of that. And
yeah.
I think Dom's saying that Fed does not set rates, the market does.
Thank you. Oh my gosh, another one. Oh, I love you.
Well, they have a very, very strong effect
on the short term.
Right. Yeah. So depending on, I mean, as you can see, we've had 10-year at what? Below 4 for a while, or right around 4 for a while, even though the Fed's. So
I had an interesting comment that.
Well, actually.
I saw this one. High national debt. Inflation is beneficial to America's national debt because we can just inflate it away. A lot of the spending, though, is tied to CPI indexes. So it will just go up. Inflation, I promise you that. Here's like a test for you to look at. Look over time, the real rate of increase, and then your whole will inflate the debt away, will go away. Not to be a Debbie Downer. This theory is good, right? In theory, but the theory assumes that the real growth of the debt is negative. It's not. It's not even close.
Saying the real rate, what?
The real rate of growth of the national debt, it's not negative. So adjusted for inflation.
It's not negative, you're saying?
It's not negative. No, inflation is having inflation's we need a way bigger.
I thought you said it's negative, which is gonna be kind of
No. We're not gonna. I'm saying we are not going to inflate the debt away. All that's going to happen is you're going to get, if that's what we theorize, they're just going to spend more and more and more and more and more and more and more. Because a lot of the spending is going to be adjusting for the inflation.
And Dom's PokeMMO, he's just talking about the Fed, their impact. And I think you and I kind of hold the belief that the Fed's a follower rather than
yeah, Fed's a follower, not a leader.
To that point, one of the things I found interesting is so one of the groups of companies I've been following kind of closely during the rate cut, I don't want to say hysteria, but people looking at rate cuts and saying, oh, this is going to be really good for this set of this industry. And the industry is housing, right? Mm-hmm. Because the idea is if you cut interest rates, then mortgages go down.
Yep.
And then people refinance and people can buy a more house because interest rates lower, et cetera. But one of the things I was looking at was like, what's the 30-year mortgage rate at right now? And then what's the 30-year treasury?
I'm guessing. I don't have it in front of me. 6%, 6 something for
best
credit score. 6.
So for
we're not talking about buy down rates, but
yeah. For 800 and up, it's like 6.15.
Hey.
30 years at 4%. So one of the things I'm wondering is like how much lower do mortgage rates actually go? The spread, one of the things someone pointed out to me was, well, the spread could tighten because historically the spread was 2%. It was at like 3%. Well, now the spread's to 2%. And if we get down to where we think, like, let's say SOFR settles between 3 and 4%, well, then, I mean, the 30 years already kind of saying that's where it's going to settle, right? Because of the yield curve. So are mortgage rates even going to come down? Really?
Yeah. Oh, Hans, I was hoping someone would say this. I'm gonna burst. I'm gonna be the Debbie Downer again. So the outlook is even more gloomy. But what? Sorry, you were gonna say something?
I mean, Hans is right, but also, good luck being any president or anyone running on that.
No. It's not even right. It's not even right. You can take the data exists for you to do this on your own. So unfortunately, the free data doesn't go back far enough, and it's only limited to the United States. But you can just take me on a trust me, bro, for other countries. That's the best I can give you right now. But the following you can do on your own. You can take the tax receipts and the tax rates, and you can adjust. This is going to be a lot of work. So you could do it yourself, or you can also just trust me, bro, on this. But adjusted for tax policy, tax rates, etc., all of that. Basically seeing that tax rate and tax policy has all fluctuated across time. The United States has remained for most of its observable history, besides World War II, where it was lower, maintained a tax generation of GDP and the percentage of between 15 and 21%. Never escaped it. Tax rates up, tax rate down. Okay, so what are the reasons? And different countries have different percentages, observable percentages. Some countries with higher tax rates have actually lower than the United States. What's that explained for?
Okay, no, let me. Can I guess this? Let me see.
Yes. Well, the explanation for that part is actually very funny, but
is it? I'm thinking like, so if I'm a country. And I'm basically always going to be stuck to having, and when you say tax rate, what you mean basically is the amount of taxes actually recovered by the government is always equal to a certain percentage of GDP.
A range. It's like range bound.
Why would this be? Hold on. I mean, part of me just wants to say it's because, like, you can't really change tax.
It always. I just want to say while you're thinking about it, it's obvious that you can't tax at zero, right?
Right.
This is with high and lower taxes.
Because people move?
No, it's actually because behavior just changes. But the reason why countries are different is also due to behavior and culture. Some countries, for example, if you look at Brazil versus the United States, Brazil has a higher propensity for tax evasion than the United States does. It has a greater propensity for the culture to exhibit tax evasive tendencies. Same with Italy. And same with Greece. And in some of these countries, you have tax rates that actually make the United States look kind of low. But they collect, and they collect lower percentages of their GDP.
I swear, every single like celebrity in Spain, I always see, they got like charged with tax evasion.
By the way, if you take Spain's data, there's a problem with the data because you have to account for the shadow economy. Because in Spain, it's so bad as far as like the level of regulation goes for even employing someone. There's actually quite a large shadow economy that then doesn't get really. You have to adjust for that in your calculation. But after making those following adjustments, you'll tend to find it's at a lower percent. So basically, the United States, regardless of tax policy across any period of time, the best predictor of tax receipts is going to be economic growth. Go figure. Holy crap. Profound data. Profound conclusion. Wow. Andrew, wow. Turns out, if you want more tax money, the economy has to grow. Oh my God.
Well, the issue.
You could do stuff to try to get us to the high end, but we're closer to the high end right now. I think we're at like 19%.
The issue is we're a developed enough economy. We're not going to grow the GDP that fast to outgrow our debt.
Sucks to suck.
Yeah.
Sucks to suck. The answer is probably more crude that unsustainable systems are unsustainable, and therefore just don't do it. But that's easier said than done because people like stuff. So it does paint a gloomy picture because the inflation narrative of we're going to inflate away the debt No, you'll just increase the spend to adjust for it. It's never worked. Oh, and you don't want that. Like I'm
The
telling
only
you,
way you
everyone
can
who
do that
thinks
is
they want that,
the
you don't.
Argentina's route and just inflate away the debt that way.
You don't want that. That will turn us from one of the most powerful countries to significantly less powerful. Well, we'd probably hurt everyone. To be fair, we're way different from Argentina because the Eurodollar system's very interconnected with the globe. So I don't think our allies would like us for doing that. We would plunge the world into some dark times.
It's kind of sad. The way I think it ends is like the U.S. just invades countries.
What?
I think the U.S. starts wars. I think ultimately that's how it ends. But I'm being like very doomerish.
I mean, I don't know, maybe, but the like for the U.S., the realization that the answer to getting out of the debt problem is likely not going to be taxes. It's just going to be how can we grow GDP and replace GDP with economy if you want, whatever. In fact, if you think GDP is manipulated, because someone said the GDP is manipulated, what do you think is GDP is manipulated up or down? If it's manipulated up, then wow, we have an ever increasing percentage of GDP as a collection of tax receipts with declining tax rates. So explain that. But
And if it's
oh, by the way, because it increased even when adjusting for that. So after the Tax Cuts and Jobs Act, the percentage of GDP collected in the form of taxation and tax receipts actually went up, like a negligible amount, but you would think it would go down. And the answer to why that is change in behavior. So you're just a toll road. I'll give an example. This is a very crude example. I'm going to build a toll road, and there's a less convenient road way over there, but I'm going to build a toll road. I'm the convenient route. You want to go through me because I'm pretty convenient. All right, Andrew, would you pay me $1 a day
to go through the toll?
Mm-hmm. I'm saving you about 30 minutes.
Yeah. Oh yeah, I'd pay $1 for that.
You pay $1? All right. $5.
Oh yeah. Well, okay, and I'm doing this every day to go to work or whatever.
Mm-hmm.
Yeah, I mean $5. Yeah.
$20.
I'm using this every single day.
Mm-hmm.
I think I'd start to go like if I was in a hurry.
If you're in a hurry, you'll go through my toll road, but most of the time you'll take the less convenient road.
Yeah.
So your behavior will shift.
Mm-hmm.
Okay, $50. Now let's go just extreme. $50 every day.
50, it's got to be like, I'm really in a hurry, man.
100.
Like, once again, this is like, man, I'm really, really in a hurry. It's
200.
It's an emergency, man.
200. Life or death emergency now?
Yeah.
Are we there yet?
No, we're not at life or death emergency. This is like, oh shit, something's really bad emergency.
$50,000.
Someone better be dying.
When will you relent? When will you relent?
50,000 is someone's dying in the back seat. We have no choice.
I think I changed your behavior already at like $20. So
yeah, you did.
Points like, made. Yeah.
Because like 30 minutes, because then you can start to play with about 40 minutes of $20, and you can start to play with that. But for me, I feel like you can plan around 30 minutes. It's short enough where you can plan around it. But anyways, yeah. So you did.
Yeah. So that's more or less the crude explanation as to kind of why we observe that. There's never going to be a perfect answer. It's just a theoretical answer. Mm-hmm. Changes in behavior account for why, even though tax rates, fluctuate up, down, sideways, etc., we experience this range-bound observation because people change behavior. You tax something a little bit, and that's why actually I forget why. No, I forget. We still do teach that in school, but like I think it's one of the things that should be emphasized more in economics classes, where taxes by regulators are often used as a deterrent of behavior because people have realized it is fairly effective, or can be, depending on the demand inelasticity or elasticity. I feel like I'm just like bringing back everyone's memories from econ classes, if anyone's attending. But anyways, so, but generally it is a good way to change behavior. So I say, I want to stop Andrew from littering. You know, he's a company and he's littering in the lake.
Oh,
I'm going to do a litter tax.
or you could be like those places like, well, if you're a company, I was saying individually, be like those places where it's like, oh, you littered, you're arrested.
Oh, but I want to make some grub, you know, money. I don't want to spend money arresting you. I want to make some money to spend on my project. So then I'll say, I determined that Andrew's behavior has a negative externality, and so I'm going to, blah blah blah, assign a tax to it so I can deter his behavior. Taxes are good for that, and you can get
That's
the
like an excise tax.
Yeah. I don't want Andrew to drive a gas car anymore. Gas cars are bad. California. I'm going to start a tax at some point in the future that I'm just going to make it unbearable. So only the rich can have cars. Or
like smoking
gas cars.
I don't want people to smoke.
No, but you see, then you get the inelasticity of,
Well, smoking is fairly inelastic. Although it sounds like some people, I think at this point, the consumer base that does smoke, it's completely inelastic. At some point, there was some elasticity to it.
Yes. Every demand curve gives in eventually.
Right.
The price.
Like, that $20 toll road, there are some people, like, as you get the people like me that kind of start to siphon out and work around it, there's those people that are just like, I'm paying $20 no matter what.
Yep.
And
here's an example. What if I told you, as the federal government, I'm going to increase the capital gains tax? We're not talking about this unrealized bullshit. I saw you, Citizen of the Year, asking about it, but imagine if you have to pay now capital gains tax 50%. I would think like 3 times plus 7 extra times before I even consider selling the stock.
No, you know what's going to happen?
What?
Loans against your stock portfolio are going to become really
No, I'm talking about the average Joe.
Even for the average Joe, I feel like that's what's going to happen. No, because think about it. If your broker, like imagine Fidelity says, you can take a cash out against your portfolio instead of selling the stocks here. I think it becomes a built-in tool there. 50%? That's nuts.
I don't think they'd lend it to the average Joe, though. That tool would not be available.
It's fully secured by your stock portfolio.
That's already margin.
Yeah, but
there's loans.
The average Joe.
No, but there's loans out there. I'm telling you, like Bank of America offered me a crazy low interest rate. And it's like they only offer it after, and you have to borrow a certain amount. They don't do it if it's too low. So like, for example, there's 2 products. There's one that has a minimum of, I forget how many hundreds of thousands. And then there's one that has there's one that has a maximum of 100,000, but it's variable. And the fixed one has a minimum that's way higher. And so you have to borrow that much. So it's not worth it for them to do the admin work on you. Because if there's a cost to any, it's like mortgages. I think banks don't want to do they don't do mortgages if it's like under 50, 60. It's always adjusting, but years ago it was like 50 or 60. They won't do that mortgage.
That's another thing. Out for fun saying then like companies would just start paying out a shitload of dividends.
No. Dividends included in that capital gains tax. What are you talking about? Because dividends are taxed at long-term capital gains. You increase long-term capital gains, boom. You don't want dividends. You'd be like, fuck no, don't give me. You'd shift behavior. I promise you. That's what would happen.
Well, I think the behavior would shift in how people recognize the gains within their portfolio.
Yes. Yeah. And the government will get maybe less. Yes.
Yes. That's what I'm saying.
That's the explanation. It's just that you're not dealing with the population of drones. You're dealing with all of you people right here watching. You're all kind of thinking individuals. You all are going to think about what are the rules in place and how can I behave in that rule set. I could just say, then we can get into like Laffer curve theories with like, I just say everyone 50% tax, no matter what, no loopholes, no deductions, nothing. And then we get into a question of how long can the economy support something like that. But
so capital gains rent income is not capital gains.
Rent
Right.
income is ordinary income. Correct.
Yeah. People be investing a lot more in rental properties.
No, well, right now. Oh yeah, because you have to, because people forget when you get capital gains tax, it's very fair. People do not understand this. It is very fair because you get double taxation.
Mhm.
United States, you get double taxed. You are an owner in a corporation that they are paying tax,
Mhm.
and then you are paying tax on the distributions that they give you. When you add up the highest end, you're paying over 40% in a non-income tax state.
Right.
You can get to 50%. Because that is taxed on you. That 21% corporate tax rate, whatever the corporation is paying tax, that is your tax. You just don't see it.
I'm enjoying this game. It's like we're adding levels to it because Dom is now saying, well, you have to keep the ordinary income tax over the cap gains rate. At that point, dude, if my marginal tax rates are 50% and cap gains are 50%, bye.
Yeah. Well, okay, that's like the ultimate change of behavior. Geolocation changes, but
Yeah, but like that's because, well, I mean, I guess you do marginal brackets, but like, anyways, it's so funny. So I guess to put a bow on this, it's complex, man. You can't, there's no like simple solution to
very.
the issue. Yeah, he's saying only on over 500K income level. I wanted to mention, by the way, there's a stock, and I don't think this is bad to mention here. So you remember like back when Monster was doing that buyback, and there was like a potential arbitrage? Did you hear about the company that's happening with that right now?
What's happening with that right now?
So there's a company called Frontera Energy. Have you heard about that?
Frontera. No.
Okay, so bring up Frontera Energy.
Frontera.
You're going to be blown away by this, but it's so funny what's happening.
FEC.
Mm-hmm. It's a Canadian company.
So it deals in monopoly money. Very nice.
Yeah.
I'm kidding. I'm joking. I love my Canadian.
So they are buying back. They're doing a massive buyback. Look at like Monster did. Remember how Monster was doing like a buyback of a bunch of shares? So they're doing a 40 million Canadian buyback of shares.
Mm-hmm.
What do you think is the price they're buying it back at?
The way you're making that sound, it's a lot less than the current price. It's a lot higher.
It's $14.98.
They're buying back at $14.98.
Yeah. So I don't know. Here, I'll send you the press release in the private chat.
Okay.
So what it looks like is the company's doing it to buy back shares from insiders. They're
giving them a sweet offer. Wow, that's a sweet
but they are prioritizing odd lots again. So there's actually two really interesting plays I think off of this, but so if you purpose of the offer, so first of all, purchase price, I'm sorry, Canadian $12 a share, not redetermined pay estimate of Canadian. Oh, offer results in a 48-cent per share distribution, and the buyback at so they're doing like a dividend and a buying back at $12. So it's $12. I'm sorry, still like an insane premium to today's price, which is nuts. But if you see, so Frontera is the one that will buy it, from what I'm understanding. I only looked at this like briefly. So if more than 3.375 million shares are tendered for the purchase, company will purchase shares on a pro rata basis after giving effect to odd lot tenders, which will not be subject to proration. In this case, shares that are tendered but not purchased will be returned to the shareholders. And if you go down, they say there's like the thing about the Catalyst Group and another shareholder. They're beneficial owners of about 54%. Each of them are telling the company that they're intending to deposit shares for the offer. Obviously, it's subject to market conditions. And then there's also saying, in addition, officers of the company have expressed intention to tender 250,000 shares. So you're having, now there's two interesting plays off of this, right? One is, and what's the date that they're planning on doing this by? Does it say the anticipated date? October 17th. The offer is expected to commence on September 11th and remain open for acceptance until 5 p.m. on October 17th, 2024. So that's partly another reason why there's such a large gap still, is like there's quite a bit of time in between there. So there's some uncertainty as well as, other opportunity costs. But I actually think what becomes interesting is shorting this company right around that October 17th too. Because what's going to happen is the people that don't get their shares tendered are like, well, I'm selling. Like, you're not interested in this company. You're interested in the arbitrage. So when you don't get filled, you sell.
Yeah, because you getting filled is very, it's not guaranteed. You put your offer in.
Yeah.
And if it gets filled, it gets filled.
And even, 3.35 million shares, 3.375 million shares. I don't know how big the float is. It sounds like the free float is something like, 50 million. Just maybe I'm wrong on that. That's a lot of float. Like, that can be bought, not necessarily move the stock a ton, and then people get, anyways. I think it's a really interesting situation because this happened with Monster, and after the end of that, Monster did sell off because of that very situation.
And how much did they even buy back? How much did Monster get through?
I think they bought $2 or $3 billion worth.
Yeah.
But anyways, this is like an interesting, funny little situation, right? Like the price is insane, but it's like you said, it's like a sweetheart deal for people that are insiders potentially. And my guess is the another thing that could really maybe hurt you on this is I'm assuming that the two guys that own like 54% are in talks with management and maybe unofficially know how many people have tendered. And so they might be able to say like, we're not going to tender, or something. But I thought this was interesting. I heard about it and I was like, what the heck? Because that's okay. So let's say, so they're doing a 48 cent per share distribution. Let's just say that they purchase at $12 per share. It's at $8.70 right now. Is that like a 40% higher amount?
That would be about there.
About 38%. Over 2 months, like that's an insane return. If you actually, it's a small amount for a lot of people. Yeah, that's the thing. If you get filled, if not, what do? You turn around and you sell that. It's one of those events where you could probably short going into it, and like I don't know if I actually ever would, but actually like make some money on it because I think it's like one of those things you can't. There's no way to like anticipate like the people selling. It's just selling pressure. But anyways, I thought that was interesting.
It's like a replica of the Monster RBOP.
Except Monster was like a couple percent.
This is insane.
Yeah.
But there's the risk that you don't get filled.
And then
you're going to be one of those people holding the bag.
Yeah, at least before you're holding Monster, it's like, what even is this company? Maybe it's an interesting company. I don't know if anyone. What do they even do? We deliver positive economic and social development Oh, that's really awesome. Good for you. Oh, their exploration production. So maybe they've been getting clapped because I don't know. This thing's gonna have really interesting share price movement for like the next 2 months, anyways.
Yeah.
But
October 17 is the end.
yeah.
So we'll keep an eye on it on that day.
Especially because if you still have like a large discrepancy, you could like buy going into it and then also short at the same time. Like buy, tender, and then short. That'd be a really funny way to. The other thing I don't know is if it's potentially open until October 17th or it gets filled, like either or, so it could close before then. I don't know if that's how it works too. I don't know a lot about it, but anyways, kind of funny.
Oh, my neck cracked. Did a big crack. I don't know if you heard that.
I did actually. That was impressive.
There was another one.
Oh yeah.
Another one in me? No, it's good.
So how do you feel about selling all of your stocks and going to wait till is it November?
Selling out all my stocks and waiting until yes. Yeah, I'm gonna follow the Meet Kevin advice. It's gonna work. It always works. I follow his advice every time.
I don't follow him, so I don't know if he's like accurate on some stuff, inaccurate on others. He seems to me like someone that says a lot of bombastic things because it gets eyes on him, which fair play.
Mm-hmm. He throws a lot of poop at the walls. Sometimes something sticks, and then he highlights it. But like the vast majority is hitting nothing. And then he highlights hard. But I don't know why people forget he lost like $30 million out of 40. So in like a year.
Yeah. I mean, yeah, he does he only just do stuff on X now? Or does he have YouTube as well?
He does both.
I think I told you this. Like, I just stopped following all the YouTube finance people that like I would hate watch. I just woke up one day and was like, "This is pointless.
Wasting time."
Yeah.
Yeah. I don't watch any of them anymore. I just have only Kevin on Twitter because I need him as my contra. I need to know like what the market's gonna do. Just always the opposite of what he says. And then if he starts to think he's oppositing himself, it's the opposite of what he thinks he's oppositing.
Dang.
He's just that bad. Yeah. And Paul's that bad,
really?
remember. Paul doesn't miss.
No, Paul I know is that bad. I don't know what he's invested in, but it's always like the same stuff too. It's like some value traps.
Well, now he's SCHD. And honestly, if I was him and I was advising him, I'd be like, dude, everything SCHD. Don't.
He's waving the white flag.
That's what I said earlier. Exactly what I said earlier. He's waving
really?
the white flag. Yeah, he's waving the white flag. Out for fun. Were you watching him back then? Oh boy. Because I don't know if you probably know this. Maybe you don't. Kevin deleted all his videos and then he re-released some of the videos. But he started with $40 million back in the clown market.
How do we know that?
He showed his portfolio.
Oh, wow.
Yeah, he had $40 million.
Mm-hmm.
The only record now you have of it is reaction videos that maybe Strongman has. I have, where I'm talking about it because it's relative. It's current news from back then.
Mm.
And he had $40 million. A lot of Tesla, a lot of other random rinky-dink trash companies like Hippo Insurance.
Why do people name
that other one?
Hippos?
Well, there's another one that's like bankrupt now. There's I know what you're thinking. The Matterport bankrupt, or not bankrupt, but like dying. The one that went bankrupt was FUV, which was
Arcimoto. He was really big a firm.
Yeah, dude, he just got absolutely wrecked.
The interesting thing is like, Enphase.
Enphase, forgot about Enphase. So, and he did like he sold out of all his stocks in 2022, And I made a meme about it, by the way, the Office meme. It's literally about that.
To be fair, he's sold at a good time, if I remember right. It's just that he got in too early.
And then like he got right back in June.
Right. So like he did a very good job actually of selling. If he would have stuck to that and like bought back in 6 months later, he would have done very well. But he bought in like 6 days later. I don't know how long it was actually.
Yep.
But like,
I just want to address something in the chat. I'm seeing you guys chit-chatting back and forth about this, but you guys are dancing around the conclusion, and it's like, yes, for you guys are arguing around each other. I think the end goal is not really the tax rate per se. It's just the capital inflow. You get a higher capital base, more a larger size based, and that's really how you grow the tax receipts.
That's why we need to bring back imperialism.
What?
go conquer some
conclusion.
countries.
Oh, I mean, there won't be like you probably actually destroy value.
You would destroy it. I'm kidding, obviously, but that's how you grow GDP, right? You just go conquer a country. Hey, man, our GDP went up 60% overnight.
Yeah, keep that value though. Keep that value. Good luck.
I'm sure all the countries that would be conquered could just continue as normal. Nothing would change.
Yeah.
No revolts.
What was I going to say though? So he reinvested everything because I'm still answering your question out for fun. He reinvested everything back in July into one stock, Tesla, and then it proceeded to get destroyed. And then in December, he put 100% into Tesla.
No way.
At beginning of summer of 2022, he might have deleted that video, but yeah, he went to the factory and he was convinced, and that's why the meme was about. Like the meme was like he was Michael Scott because he said, "I ain't fucking leaving," and he would definitely sold out of everything like 2 weeks after he said that. Because he was already getting wrecked. Like you don't understand how wrecked he was. I think he got to 20 million by that point. He went from 40 to 20, and then he went from 20 to 10, and then he got out of everything. He started House Hack. He started his ETF. He did all this crap. He grifted a lot more, and I don't know how much money he has now.
Is there? I mean, this is why I don't. No, he did not. I don't think he had TTCF. I remember maybe he did for a little bit. He actually was
a little bit. He roasted Jeremy for that.
He roasted the crap. He even told. I remember when he went through the phase. So this is when I did watch him. He would like draw on the screen. It was actually pretty cool. Like he did a lot of really cool kind of things. Like he had a little way to draw on the screen.
Mm-hmm.
And that was when they were still doing the millennial money. And he's like, "Here's what I think the fair value of TTCF is." He just drew a 0. He was right. He should have shorted it. He would have made. And that's when it was like $17 a share. And Jeremy's like, "Well, we'll see." And what did we see?
Hans, no, I don't argue for higher interest rates. Way more nuanced than that. The capital base has to grow. However, you go about that is different, because saying that you just have higher interest rates, that just implies that it exists within a vacuum, and there's no other consequences to that. And we're making a lot of assumptions about the equality among different financial systems just being precisely the same. And some entities may have more control or less control on the interest rates of a country. It's way more nuanced. I'm only saying that you have to grow the capital base.
So did you talk about where, like, what you think is going to happen, or what sectors or where you look to invest in with rate cuts and rates?
Yes.
Okay.
I briefly mentioned like some of our older pitches, like the themes. I didn't mention the specific tickers for obvious reasons, but like the themes. And then maybe some themes that will be interesting in like a year or two from now. But yeah, I think I've covered.
I mean, it's only been 2 hours, 45 minutes. So, I mean, it's only for so
45 minutes.
But no, it's funny because like, yeah, futures are ripping right now. So we'll see. I mean, futures sometimes they rip and then they just dump on open. But
what we can do is after we end here, I can hop on Discord for a bit for all our members, our nighttime discussions, because I'd love to game plan this.
Well, I think that we did some really, really solid moves in terms of some stuff we'd be more tactical about if the, and we'll talk about later.
Dom's, I should clarify tax base. Increase the tax base. More people to pay tax. You need to grow the economy. If you get more people, if you grow the economy, your tax base is going to be higher. That's what grows your tax receipts.
Marcel is asking what happens rolling up to November regarding the election.
Oh, I talked about that, but
I don't know if you have like an opinion on this. Now, from what I've seen, the rhetoric from both sides is somewhat different. But if you assume, and I don't know if this is fair to assume or not, that Kamala Harris will be a continuation in some sense of the Biden administration, and I don't know if that's a fair assumption or not. I think that the Biden administration and the Trump administration had a lot of similar policies, actually. So I don't think it matters in terms of how it affects the economy. It's like, if you look at it, they didn't get back the Tax Cut and Jobs Act. They didn't take off the tariffs in China. In fact, they increased them. Really, they were dealing with COVID a lot. I think, yeah. And she's running taxing on unrealized gains. Yeah, that's not going to pass. That's not going to happen. Didn't Biden say he was going to tax people who are 400K more and he never did? Isn't it the exact same thing?
The what?
Because he's Citizen of the Year is saying she's running taxing on unrealized gains. But Biden also said he's going to tax people like more over a certain income threshold, and that never happened.
Oh, yeah, it's just
it's right. I mean, and I'm not saying that one side is more than the other; it's just rhetoric. But that's what I'm saying. I think the actual administrations, the actual policies, is very similar.
Because when you're dealing with that, you might be dealing with actual consequences, not just like words.
Mm-hmm.
Yeah.
And you have to go through
Bloomberg had a good piece on this, basically saying both sides have moved very much to populism.
Mm-hmm.
So we're in an era of populism. We go through like swings in this. Right now, we're definitely in that for sure on both sides. And it makes it difficult to talk about U.S. politics because like U.S. politics is just like two groups, but there's like so many factions within those two groups that don't agree with each other, but they're like one party.
Mm-hmm.
And it's like crazy because then one person from one party has a certain perception of the other party because what they hate is one faction from that party. And then they just think that whole party is that faction, and then the vice versa. Like, I'll give you an example on both sides. Like, a Republican will be like, all Democrats are like, I don't know, classic socialist. And it's like, yeah, well, there is like a more socialistic-y wing to the Democratic Party. That's a faction within the party. And then there are, varying, other factions of the Democrats who are like very capitalistic.
Mm-hmm.
And then within the Republicans, there's the evangelicals, there's the fiscal conservatives, there's the whatever.
It's all
so
both
many
parties have so many characters. But my favorite thing is like during election season, you see how bad they are at targeting people. I get like, I don't live in certain states, and I get people who are like, "Hey, you should vote for me." I'm like, I don't even know who you are. So I look the person, I'm like, dude, I don't live anywhere close to this state. I never did. Why am I getting? So
I'll address this one too. These ones are adding me. Capital base has increased in the U.S. The rates are high compared to the civilized world. I think that's simplifying it a little bit.
Whoa. Who's he saying is uncivilized?
Oh, yeah. You know what? You're canceled now, boy.
How dare you pass judgment?
It's over. And we know what country you're from, Australia. We can cancel you. You're in Australia.
Well, Hans, tell us.
Do you enjoy your job, Hans? Do you enjoy your job? Do you like working? Well, you're not going to work for now. You probably work at Sydney. You're probably in Sydney, Australia. Are you in Sydney?
Or Melbourne.
Melbourne? No, well, what's that? I forget the... come on. It's... There's a part of Australia that's like extremely like he would be very cancelable if he's there. No, Queensland, no. Fuck. Damn it.
All I know is he hasn't been responding, which means he's probably scrubbing all his social media at this moment.
He's scrubbing all his social media right now. He's like, shit, they got me. It's going to human relations. No, it's over.
Are you asking like a small city?
No. It's there's are they called provinces? They're not called
They have states. Yeah,
they have states? Okay, so it's a state of what?
Queensland?
Yes. I think that's the one.
Okay.
That's the one. Queensland, the one I said. All right, so that is the name. If he lives there, he's very cancelable.
Yeah, we're flexing at U.S. education. It's like, oh, what is another irrelevant country? Oh, what's the geography there?
Irrelevant country. Oh my god.
The only one that's relevant is America. We all know this, right?
We need them.
And when I say America,
China.
it's because it's the United States of America. It's the only one that matters in North America.
We need him.
I'm just kidding. Obviously, I'm kidding. Don't cancel me, please.
I go on special margin, but yes.
Would you guys go on special margin? I know you're talking.
I go on special margin, but not margin. There's the margin for the Khmers, and then there's the special margin. I go on special margin. He can touch that. I don't touch that. I get special. For real, name all 50 states, dude. No.
Do you want the capitals too?
I can name a lot of them, but it's just I won't have the memory to say have I named that one already. And I might repeat.
No, I might be able to do all the. No, I don't think you can do the capitals still. But Dom's. Oh, we're having fun here. He's asking if you ever heard of modern monetary theory, MMT.
Yes.
Oh, we could talk about this for a while.
Yeah, short answer. I think it's clown stuff.
Yeah.
It's a clown stuff. It makes a lot of assumptions too on top of that, which is cool because it's like only very few nations in that theory could even do that, and it's assuming that it could last forever and that the conditions will remain stagnant within a vacuum. It's like that's not how things work. So, but he made good money from talks and stuff.
When did modern monetary theory come out? Because when I first heard it, I was like, this sounds like something someone made to justify the U.S. spend.
I'm not sure, but it became prominent in the last like 10 years in discourse. But I think since then it's died off. The whole government can spend as much as it wants, I don't think is really considered credible.
Okay. Fuhad's saying we should end the stream. Should we oblige to keep going? Dude, Fuhad doesn't remember the legendary like 8-hour streams.
The 9-hour and 40-minute stream is the only one I ever did, and holy crap, dude, I don't have.
And that was a solo stream.
That was a solo stream.
Dude, what did
actually a bunch of people came on.
Oh, did they?
Yeah, like I JC, you know JC?
Yeah.
JC came on. I think JP at one point came on. Echoes was on. Strongman was on. Cole was on. It was a whole bunch of people from just the audience too.
So you had people that helped you get through it.
Oh yeah, all the way through. And then like some Europeans came on.
As the Americans went to bed, the Europeans came on. It's like, hey, your shift.
Yeah, your shift. Because they've been trying to push me. Remember the prophesized 24-hour stream? Dude, that would be fucking brutal.
Dude,
I don't think I could do it.
I don't know how those like Twitch people do. I mean, like I do, but I would like. Oh, how do you even? You have to literally start as soon as you wake up.
Mm-hmm.
You got to like roll out of bed and just go, and then like have it prepared and have people bringing you food and everything. I don't know.
Yeah. All right, we'll end it here so we can hop on Discord before it gets too late, and then we can have a game plan discussion for tomorrow. All right, thank you guys so much for watching. 3 hours, long time. Timestamps are listed below. What do people say? Government official believe in OT? Oh gosh. Okay, ask that in a future live stream. We can get into it. But yeah, thank you guys so much for coming on. And if you're not subscribed, go ahead and subscribe. If you like the stream, feel free to leave a like down there. And if you're on Twitter, heart it, retweet it if you so like. And if you're so curious, the link for the club is in the description below. With that being said, thank you guys so much for tuning in today. And we'll be seeing you guys on the next one.
Okay. We'll do it live. Okay. We'll do it live. F it. Do it live. I'll write it and we'll do it live. F***ing thing sucks.